Good morning, ladies and gentlemen, and welcome back to day 3 of the BCI Global Investment Conference, the last day of the 3-day session. We had a couple of questions yesterday as well, the presentations and recordings. Yes, we are going to make it available as soon as we're done here, so we'll post it sometime next week on the Boutique Manager's website, all the recordings as well as all the presentations you are seeing here today. Another fantastic lineup for some of the top fund managers in the country. And we trust you're going to find good value from today as well. We will follow a similar format as yesterday. So for our live audience, and more than welcome to raise your hand. We've got a roaming mic or two running around here to get those questions. And to our online audience, you know how it works by now. The Q&A bubble, more than welcome to post questions in there. To any of the presenters, our moderators here has got the iPad and they'll get the questions to interact with the presenters as well. On stage already, we've got Catherine Birch from Granite Asset Management, Nick DeVos from Centaur Asset Management, and here to moderate the session on multi-asset funds is Head of Equilibrium, Flobella Yates. Flof, Catherine, Nick, welcome. Thank you so much for joining us here this morning. Good to have you here. And Flof, I'll leave it in your good hands. Thank you very much.
Thank you. Eugene always does a great opening, and I believe it's been a fantastic 3 days. I unfortunately couldn't join yesterday. It's a quarterly report back month for us. But I did attend day 1, which was phenomenal, and I'm looking forward to catching up on the recordings from yesterday. As the head of a DFM and multi-manager, it's always an honor to be joined on stage by 2 people that I highly respect, and asset managers we've used in our solutions for a long period of time. So on my left, your right, we've got Nick DeVos from Centaur Asset Manager. He is a portfolio manager and analyst and has had huge experience in running some of their top funds, which I'm sure he'll talk you through today. And then on your left and my right, Catherine Birch, who is an engineer turned analyst. I always find our conversations very interesting. And I'm looking forward to listening to your presentation this morning. So to start off with, Catherine's going to talk to us around free markets and baby turtles.
Great. So a few years ago, I was on a scuba diving holiday in Sodwana Bay, and I signed up to do a turtle tour, which is an opportunity to witness the loggerhead and leatherback turtles that nest along the coastline of the area, hatching out of their nests. And what it involved was heading out at night with a guide. We were each given a torch, and we made our way along the beach while he shone the torch out, looking for signs of life. So the turtles nest along the shoreline, and they're usually in kind of demarcated areas. And we were trying to see whether there was any movement or activity. And when he eventually found a nest, it had actually partially collapsed. So he very carefully dug away a bit of the sand, trying not to interfere too much in what nature was doing, allowing the baby turtles to climb out, catch their breath a little bit before they made their way to the shore. And what he told us, which may or may not be true, was that baby turtles use the light of the moon to guide their way to the sea. So we had to be really careful with our torches that we didn't shine it all over the place and lead any of them astray, while they made their way flapping down the beach and then taking their first little steps or first little swims as they headed off into their journey into adulthood. And I've got a couple of videos here that just show how amazing it was to witness the first part of these little guys' journey into adulthood. So you can see them flapping down the beach, and then the second video is as they reach the shore and start swimming away. But what we saw here was only a tiny part of what is a very long journey for these little guys to make it into adulthood. There are a lot of dangers out there for a baby turtle. Not only do they face threats from things like predators on land and sea, like sharks or birds, but there are also many human threats, like fishing nets or destruction of reefs, oceans warming, that are impacting their habitats. And what that means is that the odds of survival of a baby turtle are incredibly low. It's only about 1 or 2 in every 1,000 that make it into adulthood. But when they do, they can get very old. Some species live up to 100 years. And these big ones that you see here are some examples of what a turtle can look like if it beats the odds and makes it to adulthood. Now, the free market is no less brutal. You might be familiar with the research of Hendrik Bessenbender, who analyzed the stock performance in the US market over a period of around 100 years from 1926, was updated recently till about 2022. And he found that only 3.4% of companies were responsible for the entire net shareholder wealth creation over that period. And in fact, most companies did no better than cash. So finding the winners, the good companies to invest in, is really like looking for those rare baby turtles that are going to beat the odds and survive to be old and wise. And that's really what we're trying to do as investors. The images that you can see on this slide are just some of the companies that might be familiar to most of us, that were well known at some point in our lives, that have fallen victim to those free market forces. So then how do we go about looking for those companies that can beat the odds? Well, what a company needs to survive the free markets is to dig a very wide moat around the castle. What that means is that a company needs a competitive advantage, so some form of durable competitive advantage that can protect against those free market forces. And they need to keep reinvesting to protect that moat. The challenge, though, is that even with a competitive advantage, things can go wrong when a business is improperly managed or is poorly managed. So things can go wrong when you have a failure of oversight, too much complexity, or outright deception, so when there's poor governance. Things can go wrong when you have a management team that thinks short-term because of poor incentives, when they don't respect capital, or when they fail to reinvest to protect that moat. Things can really go wrong when you have a balance sheet that has too much debt or poorly structured debt, because what that means is that a business is vulnerable and fragile in the case of negative surprises, which we know can happen. And things can go wrong when there are threats to that competitive advantage. So when you have technological disruption or changes in business practices and a business fails to adapt. So not only do we look for businesses with a competitive advantage, but we also need to rigorously assess the quality of the business against these hurdles. And that's really what we do in our investment process at Granite. The challenge, though, is that wide moats aren't easy to find. But luckily, there are some industries that have natural moats. And I'm going to show you a few examples of these. So firstly, platforms or network businesses, which are typically businesses that are connecting different participants in a market in some way and enabling them to transact. An example in your world might be a Lisp. They tend to have network effects, which means that each new participant in the network is adding incremental value for the other participants. Or they have high switching costs, and what that means is it particularly happens when they become part of our everyday lives, or when they become critical to the functioning of another business. And I'll show you some examples of that later. Then owners of prime property have a cornered resource, particularly when the properties are in really great locations, or when there's some constraint to new supply coming online. An example of that might be West End offices in London, for example. Then banks and insurers have a regulatory moat because they need to be licensed, and that limits the ability for new entrants to come into the market. And they often also require significant amounts of capital, which isn't always readily available, particularly for a smaller business. And lastly, complex technology companies have a technological moat when what they're doing is something extremely difficult and based on many decades of learning. And they often have scale advantages when they're big enough that they're able to produce at a low enough cost point that makes it very difficult for someone else to compete. So these are the areas that we've gone hunting in our portfolios. And all of the names that you'll see on this next slide are just some of the companies that we currently hold. So within platforms, we like businesses like Interactive Brokers, which is an online brokerage that runs a really powerful platform that enables individuals, hedge funds, financial advisors to seamlessly invest globally at the lowest cost in the market while still making a very attractive margin and growing new accounts at 30% a year. Or and exchanges like the Hong Kong Exchange, which is really, you can still see it as a gateway for foreign capital into China and for Chinese investors to the rest of the world. Also makes very attractive margins and is basically a regulated monopoly. Then within the property space, we found some really nice property companies in areas like London and Europe. So the two names you see there, Derwent owns properties in London, especially in the West End, very high quality offices, and Unibail-Rodamco is mostly European malls. And both of these companies are incredibly well run, have very strong, well-structured balance sheets, and have properties with low vacancies performing very well. Then we really like the South African banks and insurers because they are well capitalized and resilient. They've surprisingly proven their ability to perform even in a very poor economic environment in South Africa. And within the names that you see there are a few examples of more growth businesses like Capitec and Outrance that we think still have a long runway to go. And some of the more traditional banks like Standard Bank and Nedbank that can do really well if we get more growth in South Africa, if things turn a little more positive, but you're buying them at very attractive dividend yields still. And lastly, within the technology space, all of the names that you see there are companies that are involved in the semiconductor supply chain. So they in some way enable the production of computer chips, which we use to process and store data in our increasingly digital world. And what these companies actually do is basically bending physics to be able to squeeze millions of transistors into a tiny space, working at the scale that's a fraction of the size of a human hair. It really boggles your brain when you think about it. And because what they're doing is so difficult, within each area of the supply chain, there are really only one or two companies that can do what they do. So they have wide moats, and it makes for very attractive investments. Now, we know that things can feel very scary when the world is in a very volatile place in terms of economies and the geopolitical situation, like we've experienced over the last few months. But the world has always been scary for baby turtles. And what we try to do is not to make rash decisions in a panic, but rather to slow down and to really think, what are the things that we think are likely to create good investment returns for the long term? And we think that means continuing to hunt for those companies that are well run, have a wide moat, and holding on to them for a long time. And so we will keep hunting for those rare baby turtles that can beat all of the odds and thrive. Thank you.
Thanks. Okay. Good morning, everyone. Thank you, Flabella, Eugene, for the introduction. And also thank you to BCI and the team for once again putting together an excellent conference. Today I'm going to be doing a presentation that's a little bit different to what we usually do, so going a bit off-piste here. But there's a very simple message that I'd like for you to take away from this, and it's exactly that word, so simple or simplicity. I think both locally and internationally, clients, investors are spoiled for choice, and that doesn't necessarily lead to the best outcome. So if I ask everyone in the room, if you've ever looked at the global investment landscape or the number of funds that are out there, even the number of funds that are in South Africa, inevitably I would assume that most people in the room would have had some bit of confusion at some point in time. Just in South Africa, there's just under 2,000 unit trusts to choose from. And the truth of the matter is that I don't think this industry or the number of funds wasn't designed to help clients, but I think it's actually designed to sell products. If you think of it a bit differently, different themes or different cycles that we've had over the years, maybe the 1990s, early 2000s, tech was very in vogue, and everyone was launching a tech fund in the hope to attract assets. You've heard things like Fourth Industrial Revolution, AI. Of late, gold is performing very well, and I wouldn't be surprised if managers at the at the back of the pitch deck, where the gold fund was hidden, is now finding its way to the front of the pitch deck, showing you very impressive returns in the hopes to gain from flow of funds. This picture, I'm sure you've all seen before, but I think it's worth looking at it again. So if you look at that early 2000 period, there were more shares listed on the JSE than there were unit trusts in the country. Today, 2025, just under 2,000 unit trusts in the country, and then there's 270 odd shares listed on the JSE. So the end client has a lot of choice, but the actual, this side of the table, fund managers have limited choice. In terms of investable shares of the JSE, there's probably just over 100 that actually are investable. And the point of this is, on your guys' side of the table, I think you're overly spoiled for choice. There's too many options to choose from, both in South Africa and overseas. So if I take this to a very simplistic example, a lot of choice can often lead to indecision. So on the left-hand side, I've found a Chinese restaurant on the internet. I've taken a screenshot of their menu. This is just one of the pages, and there's 84 different items on the menu listed here. They've even done us a favor, and they've given little pictures just to show you what you're actually ordering in case you don't know. And on the right-hand side is an example of one of my favorite restaurants down in Cape Town. There's the starter, the main course, and there's the dessert. Now, kind of the trick of the menu on the right-hand side is that that's what you're being served. So the chef gives you the menu. You don't get to pick what he's making. He sources local ingredients. It's what's in season at that point in time. And knowing or having been to the restaurant a few times, the food is always excellent. The restaurant on the left-hand side, if you pick something like, I think it's number 81, there's a Kung Pao shrimp, you don't know if you're going to wake up the next morning with food poisoning. So bringing this back to investments and asset classes, this is also something you've probably seen before. So I'm ranking here by year which asset class outperforms, and usually every year it's very different. So us at Centaur, we find it extremely difficult to say which asset class or which region is going to outperform any given year in time. So I would understand for you guys it might be even more difficult. For someone that's going and picking a fund in China that's performing, or picking maybe a fund in Europe in a specific value or style, whether that's performing or not, to consistently do that, I would say is near impossible to do. So a potential solution to this is multi-asset funds. So if we try and narrow that decision down, so I've already said there's close on 2,000 unit trusts in the country, but looking just at multi-asset funds, it's still a very difficult decision. There's over 1,000 of them to pick from in the country. So I'd like to focus in on flexible funds. So there are 53 flexible funds available to investors in South Africa. They make up just under 4% of the unit trust assets in the country, and I actually think they are quite underrepresented. So kind of the goal, or what flexible funds are, it's for the investor that's looking for equity-like returns, but with lower volatility. I'd also say it's typically for investors that have discretionary funds. I think it's one of the purest forms of kind of investment vehicles that are available to investors in South Africa. It's also not constrained by the Regulation 28 limits. The table I've put up there just illustrates to you how the flexible fund category average has performed versus the balance category and the SA equity category, and over a 7-year period has managed to outperform both those. I think in South Africa there's also a handful of excellent boutiques to choose from that do manage flexible funds. So taking us back to Centaur specifically, so the golden line on the chart is the performance of the Centaur Flexible Fund. And if you look at all those lines below it, those are essentially the components of our benchmark or kind of the asset classes that make up the fund. And interestingly, we can move between a combination of these, but interestingly, if you look at the white one, that's the Morningstar Developed Markets Index, but you'd all be more familiar with the MSCI World that essentially has done the same as what that white line there has done. The flexible funds managed to outperform the best of the different asset classes we can choose from, and the way we've been able to do that is through stock picking and generating alpha that way, and that's really what Centaur does. Then last year, Centaur reached the flexible fund reached its 20-year anniversary at the end of December. Over that time period, it's the number 1 unit trust in the country out of 485 funds, according to the Morningstar data. And what's interesting about this is if you go through the list of the top 10, it's the only multi-asset fund in the top 10. But I think what's more interesting is if you look at the other funds in the list. So if you look at, I'll start at the resources fund as an example. Gold's had a very good run of late. China's had an infrastructure boom. Will that continue? Is India going to take over where China left off? It's all very difficult kind of decisions to make. In terms of a growth fund, growth's had a very good kind of run the past decade. Is it going to have a similar run over the next decade, or is value going to perform again? In terms of global equity, the US makes up a very large component of indices. I'm not saying every global fund is all up into the US, but the US has had a very strong run over the past decade and over many years. So the question, over the next 10 years, will that continue or not? So these are all very difficult decisions to make. So what's on our menu? So we keep things simple. We only have 3 funds. We recently launched the Centaur SA Equity Fund just over a year ago. The flexible fund is kind of like the chef's pick. It's for all conditions. It's the longest running fund that we have. The balance funds manage in a very similar fashion, but it's Regulation 28 compliant. So that's where pension funds are able to go into. And then the SA Equity Fund, I'd say, is a bit more of a building block, or if you're looking for very focused SA equity returns. And I think if I was to stand here in 5 years' time when we turn 30 years old, I'm pretty sure there won't be more than 4 funds on this list. So for a fund manager been running 30 years to only have 4 funds, we like to keep things quite focused. So just to recap, I think keep things simple. There's a lot of good chefs in South Africa running flexible funds. You just need to pick the restaurant that you go to, and I think flexible funds are a good option, especially for discretionary funds. And that's my story. Thank you.
Thank you. Thank you both. Very interesting presentations. They actually both really resonated with me. I recently did a turtle walk to watch the turtles hatch, and it was amazing. And I'm one of those people who, when you get a menu with too many choices, I can't actually decide. So, for the online viewers, please feel free to post some questions online. I see there are none at the moment. And before we go to the audience, we've got about 10 minutes left. I've got a couple of questions. Obviously, this is a multi-asset panel, and you both spoke to how you think about construction and why flexible funds is potentially the way to go, and why it's important to look for those winners. I love the analogy that turtles that survive get old. It talks to so many things in our industry: survivorship bias of unit trusts, survivorship bias of actual asset managers. How many asset managers have merged or disappeared? But I guess let's start with you. When you look for opportunities, obviously with the Regulation 28 changes, we all manage both compulsory and discretionary money. It's created an opportunity to take a lot more offshore. So Catherine, as a South African-based manager, how do you find opportunities to invest in offshore stocks? You mentioned one or two today. How do you find those opportunities? Do you think you had a disadvantage to global managers?
I think if I think about our investment process, firstly, our benchmark is an absolute benchmark, so the flexible fund aims to beat inflation plus 6, rather than being linked to an index or something like that. So we're not having to have a view on every company in the world. What we spend our time doing is trying to find the good companies. And then, like I spoke about, our quality hurdles, that really makes it quite easy to screen things that we think are definitely not something we would want to invest in. So even as a small team based in South Africa, we can really cover a lot of ground, because we can tap into an area and easily go through a long list and say, there's something wrong with the balance sheet here, they've done something dodgy, can't trust that management team, and screen out from that into the companies that we really do a lot of detailed work on. So I think that's one part of it. And ideas can really come from anywhere, and I think that's the beauty of it. Like within our team, we all read different things and are interested in different things. So ideas can come from a podcast, it can come from one of us attending a conference, it can come from sell-side research where you hear someone's stock pitch, many different areas, or it can come from our macro work where we identify a place in the world where it looks like property is really hated at the moment, so let's go dig and look for some good property companies as an example.
Okay, thank you. Nick, I'm quite interested in some of your stock picks. I know today your presentation was a little bit different, but can you maybe talk us through a particular offshore stock that you've liked and why you've liked it and how you found that opportunity?
So maybe first, like similar to Catherine, ideas can kind of come from anywhere. So, example of a company we really like at the moment is Delivery Hero. And a lot of people in Audits might be familiar with it because Prosus has a stake in the business. So that's actually where the idea originated from. So we've been following it for a number of years. But what we quite like, if you take like a big picture view, kind of before 2020, the food delivery business or businesses globally were there was free capital almost anywhere. A lot of venture capital firms, private equity firms were throwing a lot of money at these businesses, and a lot of new ones were popping up all over the show. Kind of post that free money era, a lot of this money has left the industry. And what's actually happening now is these businesses are having to be run for profit. So there's consolidation happening. There's a lot more focus on running these businesses for profit versus just growing them at any cost. So we think that we are at an inflection point, and really the ones that you want to back is the leaders in the respective markets, because we do think it's a winner takes all type of an industry, and Delivery Hero is kind of a leader in most of the markets that they operate. More recently, they sold a stake in a business called Talibat, so that fixed their balance sheet. They sold about 20% of it. And just the Talibat holding that they have is worth probably around 23, 24 euros. And then Delivery Hero share price is 26 odd euros. So their core markets, South Korea, Taiwan, parts of Europe, you're getting all of that for free, just for context.
Thank you. I think where we are at the moment, it would be amiss of me not to talk about gold. I know both of you don't hold gold, but I actually just this week looked at 117 equity funds, and only 13 of them had outperformed year to date, and it was all a gold story. And actually for the 1 year period, only 16. So most managers actually don't hold gold. Do you want to talk me through why you don't hold gold? And I don't know who wants to answer it.
I'll let Nick go first.
So, we kind of stick to our principles. We don't think gold miners are value creators over time. If you look at gold fields before this recent run-up, essentially moved sideways for a 20-year period. And that's really, all that needs to happen is for the gold price not to move. If gold stays here for a protected period of time, the gold shares are going to materially underperform. And we don't think we have any edge in predicting what the gold price is going to do. I think the only thing that's kind of stayed constant, or the thesis guys have, is that central banks have been buying gold. But not too long ago, 2012, 2013, central banks were actually net sellers of gold. So, at what point do we reach an inflection where jewelry demand starts substituting maybe to platinum? That's 70% of gold's demand. It's just not really a space that we get involved with. You stop there.
Okay. So I just want to say that Central holds no gold,
0.
which is an active position, right? Because if you just held the benchmark, you'd have over 10% in gold. How about Granite's view on gold?
Well, yeah, probably quite similar. The investment horizon for a flexible fund is at least 7 years. So we're trying to deliver the best returns that we can over that kind of time frame, rather than the best returns over 1 month or 3 months. We certainly think about things like gold a lot, but I think we struggle with the idea of investing in something that is hard to value. And I think that's what it comes down to. Rather hunt for the good ideas that we know are going to do well over the long term.
Okay, thank you. I know we've got about 2.5 minutes left. I'd like to give the audience an opportunity, but I see there is a question from Robert Foster online to say, how should a DFM cope with performance fees in model portfolio scenario where advisors and clients are very focused on lowering fees? I can't speak on behalf of all DFMs, but at Equilibrium Investment Management, how we deal with fees is we are very cognizant of fees, and we would advise our clients, whether it's advisors or end investors, to always look at performance net of all fees. That should include our fee as well as all the underlying manager fees. We prefer not to have performance fees in our portfolios, so we would often take a slightly higher base fee, but at least you know what fee you're going to get rather than a variable fee. We find that's a lot easier for our clients to cope with. And I think the DFM industry in South Africa and globally, we run a global business, so we do have offshore solutions as well, has been very good at driving down overall investment fees. But remember that in order to appoint professional managers, the likes of which you would have seen throughout this conference, they're not running a charity, so they do need to earn a fee. And I'd argue that the managers that have skill are able to do it effectively. And one other thing, just on fees, to perhaps think about the sustainability of a business, because anyone can charge a low fee, but if that manager is not going to be around in the long term, your client's money is not secure. So I hope that answers that question. Are there any questions from the live audience? A mic, please.
Hi, thank you. This question is for Nick. I see on your balanced fund, on your flexible fund, you have EXO and Remgro. So I just want to get your idea on why you're holding those and why are they in your top 10, specifically like the holding company structure as well. Thank you.
So EXO we've probably held for close on 10 years. We think John Elkin is a value creator. He's trading on probably in excess now of a 50% discount to some of the parts, but that's not enough. To be honest, I think we would have liked to see a bit more proactivity from them to unlock that discount. But more recently they have undertaken a buyback. We actually wrote them a letter, and I don't know if it's because of the letter, but they're implementing one of the things we asked them to do. I think it's compounded at 15-16% per annum. We don't see any reason for that really to change. And then I guess Remgro is a little bit different. So we hold it. We have actually been reducing it a bit. Remgro also trades at a big discount. I think discounts are often, the problem with them is that they can often lead to value traps. So it's really what's Remgro's management doing that's going to unlock that discount. We would like to see them do buybacks way more aggressively than what they are. Their Discovery holding, potentially sell that down. And there's a number of other things we'd like them to actually do. But the underlying portfolio, other than OUTsurance, Discovery hasn't really been growing NAV. So it's actually one we've been lightening.
Thank you. I know that we probably do have a couple more questions. We've run out of time. Eugenia, am I allowed to take one more question from the audience? Yes, one more.
Clients like to see managers investing in their own products, and certainly flexible funds allow managers to express a fairly pure view. Probably the most pure would be a hedge fund. Can I ask you guys, putting you a bit on the spot, your team's liquid net worth, is that more in your balanced mandates or in your flexible equity type mandates?
I wouldn't be able to answer that for everyone, and it obviously does depend on whether it's within a product that has to be Reg 28 compliant. So if I could speak for myself, I think most is in the balanced fund because it's a Reg 28 fund, whereas the flexible fund isn't. But what I can say at Granite is that everybody at Granite is invested in our funds, and I can speak for myself that my entire savings is in Granite's funds.
So retirement annuities, balanced fund, and then anything other than that, flexible fund.
Thank you. Thank you to both speakers. Always a pleasure to share space with both of you. So thank you for that, and thank you to the audience for your participation. I see there are suddenly a couple of questions online, which I'm sure the managers will respond to. Thank you for your time.
Many thanks, Floff, for making for interesting conversation, and 100% right. The questions that are still open, we will circulate to the presenters and post that back as well. Catherine, Nick, thank you for great presentations. Right, coming to the stage now for our next session on fixed income. Pierre Clark, Managing Director at Apex Investment Consulting SA. He's being joined by Philip Bradford from Portfolio Metrics, Shwebe Kosha from Laurium Capital, and Conrad Wood from Alawani Capital. And while they're coming to the front, Apex Investment Consulting consult to numerous Cat 2 FSPs as well as institutional investors, providing them with asset allocation modeling and fund manager research, and also provide full discretionary services to Cat 1 intermediaries. Gentlemen, thank you very much, and lady, thank you very much for joining us here this morning. Always great to have you. Thanks, Pierre.
Thanks, Eugene. Good morning, everyone. Thanks again for the opportunity. I spent a bit of time on my introduction, so give me a few minutes. I thought, given that fixed income is not necessarily the most lively topic, although the speakers will make it lively, I thought I'll try and liven it up a bit with a few stories in the introduction. I really enjoyed Dion Gouse's presentation yesterday when he talked about how blessed we are in the industry to have this, the good support networks of teams. And I thought I'll start by saying how far back I go with Philip, to the extent that I was on an interview panel at a big life insurance company when he kind of was looking for a job probably about 20 years ago. You probably can't remember it, but anyway. And I thought of telling how far I go back with Conrad, probably 20 years to old RMB and First Rand days and what we had to endure together. So that gives me an idea. But then, and Shwebe, I don't know that well, but I'm sure I'll get to know her well. But I thought, that probably says more about my age than anything else. But I must also say, on this topic of support to each other, Conrad, and he knows it, he's on my speed dial. He's kind of my go-to guy when there's a credit event in the industry. Because he's, and I hope I don't jinx you, as my kids would say, but he's a steady pair of hands. So whenever there's a credit event that I need to understand, I call him and say, okay, listen, this has happened. We can't get hold of the portfolio manager. I assume you don't hold it, but what can you tell me about the instrument? So thanks for that, Conrad. As I said yesterday, the Allbee gave us 20% on a 12-month basis to the end of April versus the all share of 25. So from a fairly defensive asset, we made some really good returns in the last year. Now, I think in one of these presentations, SA bonds is referred to as a risk asset, and maybe it is from an emerging market point of view, but we had really good returns. So I think in that context, it will be interesting to hear about future expectations from the managers. And then I just want to tell one more story, also related to my age, unfortunately. My kids always say I'm crusty and I don't have the riz and so forth, so they won't appreciate this story, but it's a story about chomp chocolates. You know what a chomp is. Now, you get small chomps and big chomps, I assume, still. But I can remember, and I'm sure, sometimes your mind plays games with you, but I don't think I told Philip the story just now. I don't think I made this up. I can remember in my lifetime, there was 1 cent and 2 cent chomps, the small ones and the big ones. And then it became 5 cents and 10 cents, and then 20 and 50 cents, I think, at some time. Now, 2 days ago, I've got a bit of a cold, so I went to Clicks to get medicine. And they always put the chocolate there where you queue to pay for your stuff. And the prices were on display. And I would like to tell you that a large chomp, which looks a bit smaller than what a large chomp looked when I was little, cost R8.99 now. R8.99 for a big chomp. So I think the moral of the story is inflation is real, even if it's low, as it currently is in South Africa. It is a slowly eroding force, and therefore I believe, and we believe at Apex Investment Consulting, that even if you invest in, let's call it defensive fixed income for clients and for conservative clients, you need to sweat those assets. We need to get a real return from fixed income after inflation, because it is really a truly eroding force. So I think the managers speaking today are good examples. We prefer flexible managers in this space that can sweat a bit more out of the fixed income assets, and they are good examples of it. And I think in terms of what we look for in a fixed income manager or flexible fixed income manager, it is flexibility, but it is also a steady pair of hands. And I think you must always keep that in mind. So with that, we'll start with the presenters, and the order is going to be Philip, Shwebi, and then Conrad, and then we'll take some questions at the end. You're welcome to post questions online, and we'll take some from the floor as well. Thanks.
Thanks, Pierre. Thanks for the invitation. And back to your story about how, let me move forward there. I'm talking about producing consistent returns in an inconsistent world. And, we grew up in a bond market 20, 25 years ago, where cash was 12 or 13%. And for quite a long period of time, if you go back to just around 2008, bond yields were sort of 7 or 8%. So now it's the other way around. Cash is sort of 7.5 and probably coming down, and bond yields are we're just over 12% just a few weeks ago. So we've had a crazy world, and the world changes, and we need to be dynamic or flexible and move around that. So what's been happening? The old proverb says that when elephants fight, it's the grass that suffers, and we know this always in South Africa. We like a cork bobbing along in the ocean. We might take ourselves quite seriously from time to time, but actually what happens in the rest of the world is far more of an impact on our local investments than anything that the government can get up to here. And what's been happening? So we've had some interesting times, as we know. Here's a picture showing Xi reading Trump's book, The Art of the Deal, and Trump reading The Art of War, in reverse, of course, being China. But effectively, this is the start of the deal. And what we need to understand, of course, is how does this impact other investments? It's all very well getting excited about all the news articles and things going on, and Trump getting aeroplanes from Qataris and things like that. But what is the major impact, and what is the game about? So it's important to first of all understand what does the US offer the rest of the world, and particularly what do they export, and what do China export when you're looking at their trade agreements. And really, at the end of the day, the US has quite a lot of strength, not so much in manufacturing. It exports a lot of semiconductor and high-tech type equipment. They don't produce all the underlyings, but that is really what this game is about. We can talk a lot about how inflation is going up in the States and how this may impact things. I've actually just come back from Chicago a few days ago at the CFA conference, and you haven't seen a lot of impact this year yet. But what we need to realize is a lot of this game is about US versus China and the fight around AI. That was like the key theme at the CFA conference. We just couldn't get away from it. And we can get caught up in all this, the side hustles and the deals and all these things. But really, at the end of the day, we're seeing through these deals, the deal done with the UK, etc., that it's about China squeezing them out because that's where the big trade deficit lies. And it's about it's the race as to who's going to be ahead of the AI game into the future. But most importantly, as an investor, we need to understand how these things impact our investments and the key impacts that we've seen so far. If you look on this slide here, what it's actually showing is what the forecasts were for GDP just before and then just at the end of March, and then the current forecasts, which were sort of at the end of April. And the interesting thing, of course, to note is that the growth forecasts are down for the first few years, but then actually start picking up again, which I'll come back to in a moment. The next thing is inflation, which of course we know is picking up. But what you'll notice, of course, is inflation is a growth rate. So quite a lot of that starts coming out of the system again quite quickly. And then most importantly for us, particularly as fixed income investors, is what is this going to do to interest rates? And really what we've seen right now is it's created a lower growth environment, which actually as a bond investor is all else equal, a good thing, because what normally means lower interest rates, but not always a good thing, as I'll talk about just now. Higher inflation, this is the challenge, because lower growth and higher inflation aren't really what you want to see as a bond investor. And then, of course, uncertain rates. Initially, the view has been for US rates to be lower than they were at the end of, as the view was the end of March, and for South African rates to stay slightly higher. And really what the Reserve Bank needs to be doing at this stage is indicating to the market that they will stamp out inflation if we do have any flow-through problems into South Africa. So it does mean a slightly higher repo rate for longer in South Africa. However, though, as I'll show you in a moment, we've got some challenges there. As an investor, though, what do? We don't invest in economics, we don't invest in GDP, we invest in instruments, and we've always got to decide what is in the price. And what we really know is historically, here we are right now, this is policy uncertainty. This is the index of policy uncertainty, and it's showing that policy uncertainty is at the highest it's been since COVID, and it's effectively one of the only other time it was higher than that was in 2008 as well. So we've got an enormous amount of uncertainty into the markets right now. But what do we do during uncertainty? Here is a chart showing consumer sentiment, the consumer sentiment index in the States, and what is your 12-month return if you invest at the different peaks or troughs on that. And what it's showing is that if you invested at the 10 peaks of consumer sentiment. In other words, when the outlook is best, when everyone is the most positive, your average return on the S&P 500 has been 3.9% for the next 12 months. And at the low points, so we've got 9 sentiment troughs there, the average return has been 24%. So where we are right now and where we were effectively at the end of April was one of the 9 to 10 lowest points we've got over the last 50 years. So really what it tells you as well as an investor is you can get very clever and you can predict what Trump's going to do and you can predict what the economy is going to do, but you might get the investment call wrong because you've actually got to do the exact opposite. And that's, as a fixed income investor, we're looking at 20 years out. We're not just too worried about what's going to happen in the next 5 or 6 months with interest rates. As an investor, if you're buying a 20-year bond, you've got to have a 20-year view on interest rates and inflation. And where we are sitting right now is an interesting one. Back to my points around Pierre and his trumps. If you have a look here, you've got the South African 20-year bond, which is like the 20-year fixed deposit rate in South Africa. Look at the gap between that and the repo rate. But importantly, look where it was, as I mentioned just now, back in 2006, 7, 8. We had the exact opposite. You were getting 4% below cash from your government bonds in South Africa, your fixed rate bonds, and there was a supply and demand reason for that. At the time, the government wasn't borrowing money. It should have been borrowing money to spend and build more power stations and fix up the infrastructure, but it wasn't. And that's the reason we had a shortage of supply and an excess of demand for our bonds. Subsequently, what's happened now is we've taken on a lot more debt in South Africa, but now the bond yields are reflecting a huge gap between that 20-year bond and the cash rate. So you're getting effectively close to 5% above that, above cash right now. And then when we look at the real interest rate in South Africa, so this is the SARBs rate, and you can see the gap that we've got between the SARBs rate and inflation at 2.7 currently at the moment is the highest it's been for over 20 years as well. So not only is the bond yield higher than the cash rate is massively higher above inflation. So this gives the Reserve Bank actually a huge amount of scope to cut interest rates. But they can't cut interest rates unless the rest of the world starts, because the SARB's job is to keep the credibility of the rand, of our money in place. The SARB's job is not to look after inflation, it's to keep the stability of our currency. And that's really what you're trying to avoid by keeping interest rates at these high levels. So the good news is the SARB does have room to cut interest rates. The tough news is that interest rates will probably stay a little bit higher for longer. Now, that's not necessarily a bad thing if you're an investor, of course. That's a bad thing if you're borrowing money, but if you're fixing rates at these high levels, that's quite a good situation to be in. So what does it mean from the current levels? This is a chart showing on the x-axis on the bottom, if you bought the All Bond Index at a certain yield, what will your return be on the y-axis over the next 2 years? And I'll go through it in a bit more detail in a moment, but that's where we were sitting September last year, where the yields that were available, and that was some of the more longer yields. And that's where we were actually able to get yields. That's where the yield of our fund was actually sitting. The Dynamic Income Fund was sitting around April the 7th. And what this really tells you is that line suggests that when you buy bonds, buy fixed deposits at low yields, your average return is going to be relatively low. When you buy them at higher yields, your average return is going to be very high. It's far more reliable, as I'll show you in a moment, than what we see out of the equity market. So if you bought the All Bond Index at an entry yield of 8, 9, 10, 11, 12, 13%, what was your average return over the next 6 months? And that's what we're seeing on this chart here. And you'll see that it's off current yields, it's actually around about 8%. Over 12 months, the return moves up to about 15% of current yields that we're getting out of some of the longer dated bonds. And on a 2-year period, your annualized return of current some of the longer dated bond yields gets closer to around 15%. But most importantly, you'll notice that that gap is quite narrow. So your average return sits somewhere between sort of 12 to 16%, which means that if you've got a 2-year kind of time horizon, the probability of returns being in that space is quite high. And this is just the All Bond Index. You know, us as income fund investors, there's a lot of different instruments that are available to us, but this makes up about half of our portfolio right now. Now, that's the current yields that we're getting out of some of the longer bonds. Now, if we look, and that's where things were at the end of April, if we looked at the equity market in South Africa and we applied the same lens, so if you take the price to earnings ratio and you invert that, you get what we call the earnings yield. And if you buy the market at current sort of levels, your average return tends to be close to, believe it or not, to also about 14%, so a bit lower than the bonds. But you'll notice the dispersion there is anywhere from, on a 2-year basis, your average return is anywhere between, annualized, anywhere between minus 10 to sort of plus 50. So what you're getting from the equity market is your expected return from current levels, and that, you know, we all know that can be quite unreliable. The valuations can change quite quickly, but your range of returns are much wider. So your expected return from bonds right now, just based on history, is a little bit higher than you would get from equities, but actually your probability of getting that return is much, much better. So in other words, a lower risk or a lower standard deviation. So when you compare the two together, we're actually in a situation where the type of returns we're expecting from bonds are better than they've been over the last number of years, because we're locking at yields at much higher levels. Now, what's your other alternative? Because not everyone's comparing equities and bonds. What about cash? Now, what we've done on the chart here is we've put cash, so your Steffi rate effectively, and we've modeled it as a fund in the multi-asset income category. And what you'll see over time is that's the first quartile funds. This is on a rolling 12-month basis. There's your fourth quartile funds, and cash actually shows up as a fourth quartile asset. So if you're going to be investing into cash right now, if you're worried about the volatility of the market, you're actually going into a fourth quartile fund. You're locking in yields about 4%. We're yielding about 4% above cash in a dynamic income fund right now, which means that you need markets to sell off aggressively for you to even close to be right in cash. And then if we look at over the longer period of time, there's our track record. We've been managing this portfolio, this mandate for almost 10 years now. We've been sitting pretty much consistently in that top quartile. And there's only one or two little points in time when you look back on a 12-month basis where you've actually been slightly under cash. And those were during the COVID times and then during the reflation, Ukraine invasion, and all that trouble we dealt with not so long ago. So what can we expect over the next while? The nice thing I like about bonds are like a glorified fixed deposit. Of our current yield, this was at the end of April, was around 11.5%. We know that all else equal, if things stay the same, we should be getting close to about an 11% return, because that's the fruit that comes off the tree, essentially. If we have a bad scenario from here, in other words, if interest rates sell off, don't come down, if interest rates go up, and bond yields sell off by 100 basis points. Now, bear in mind that's way worse than we were during Liberation Day. We're about 50 basis points stronger than that. We're getting back to sort of grid shutdown sort of levels. Your 12-month return would be closer to about 9%. And if we had a 200 basis point sell-off, we get to effectively the highest yields we've seen on bonds since the late 90s when interest rates were in their 20s. You would probably be looking at a bad return of around 6.5%, which is actually still a return that all of us can probably live with. And in a good scenario from here, we could be getting closer to about a 14, and in a very good scenario, close to 17. But most importantly, if things stay just as bad as they are around the world, we should be getting close to about a 10 or 11% return. And that's on 1 year. But if you look at it on 2 years or 3 years, you'll see that the range of returns, even in this disastrous scenario, if we have a massive sell-off from here, if things stay terrible, just given the nature of the yields that you're getting out of these instruments, you reinvest your income at higher yields, a bad scenario would be close to 10. And 10% a year is still a return that pretty much you'd be lucky to get out of equity markets over the long run. So how's things been happening? Well, the nice thing actually is that this last 10 years that we've been managing this mandate, we've had a really good 12 months, up about 17% to the end of April. If you think of what we've been through, that SA elections, US elections, rate cuts, the AGOA noise, and the Trump tariffs, you've still actually done a decent return. That's an unusual return, but most importantly, if we look at the longer run, over nearly 10 years now, we've lived through the AGOA exclusion, the tariff war, Trump 1.0, Nenegate, Ramaphoria, the rate hike scenarios, Ukraine invasion, inflation crisis. Through all of that disaster, we've still been able to generate a return at nearly 4%, about 3.5% above cash, and just under 3% above the peers over that period. So at those levels, when at the starting period back then, bond yields were closer to 8%. They're now significantly higher than that. So from a starting level where we are now, ironically, it's a much better chance of us doing decent returns going forward. So just to leave you here with Howard Marks. So Warren Buffett's recently retired, and he's sort of the people's favorite from an investor perspective. It's very hard to replicate what Warren Buffett has done, but the equivalent of Warren Buffett for fund managers, particularly I would say fixed income managers, if I could speak for myself, is Howard Marks. He puts out newsletters that are incredibly informative, and he's the investor's Warren Buffett. And he's had a couple of quotes that I thought would be relevant at this point. He says, "You can't predict, but you can prepare." And in investing, what is comfortable is really profitable. So as investors, like we did in April, we significantly added some fixed rate exposure and bond exposure to the portfolio. When we could get yields at over 12% again, it made a huge amount of sense just to lock in those yields for many years to come. As investors, we can't get caught up in the noise. Our job is here to worry about it, so you don't have to worry about it. And as a fixed income investor, we need to be able to adapt, and we need to move quite quickly when those sort of opportunities happen. You don't have time to wait for the end of the month to switch from one fund to another on a platform. You need to be able to make those decisions. And as we did quite on April the 7th, just after the Liberation Day, we were able to lock in some nice yields at higher levels for clients. So as investors, we know that being comfortable is not a good thing, and we learn to embrace that. So really, I encourage, obviously, from investors' perspective, during these, for your clients in particular, during these difficult times, we really need to be able to encourage our investors to embrace the volatility and take advantage of that, because that's normally the best time to invest. Thanks very much.
Thank you. Thanks, Philip. Next up, Shwebi. Shwebi, you can take your time. Don't rush. We're still well on time.
Of course. Thank you, Pierre, and good morning, everyone. So we have titled our presentation, "In a Year of Uncertainty." It sure has. We're not even halfway through the year yet. What are the 3 things that we are certain about in our local fixed income market? And I'm sure people from the audience, as well as the speakers that come before me, we can at least agree on one thing, and to attest that we are traversing a period of unconventional policies, and most certainly unconventional wisdom that we've seen thus far. And so for fixed income managers, we're thinking we have to be active, we have to engage and to participate and make decisions for our funds. So what are our guardrails that's going to safeguard us, that give us that confidence and a level of certainty? So we've distilled this presentation into 3 themes. And firstly, the South African Reserve Bank. Now, we feel that we are in a safe pair of hands. Now, this is one of the key financial institutions in South Africa, and we've had raving reviews that we know that is well trusted and well respected, from the likes of IMF, and part of the reason actually why credit rating agencies give us such a higher rating purely on this monetary institution side. And then what are we now as fixed income investors look for in policymakers? Okay, I would just think that 2 things that I would like to highlight. So it's credibility and independence. You want a central bank that is not really swayed by the external noise, and we sure had a fair share of that on the political side of things. So and also clear communication. So these are economic agents that not only impact our funds, but the rest of the economy. And what does that look like? We have your wage setters, your trade unions, your business people, your analysts that would like to know what are our inflation expectations in the next 5 years or so. So that communication is quite key. And how does credibility look like? So this chart over here, we know that the Monetary Policy Committee meets every 2 months, and they will give us their decisions on the repo rate, which is the blue line. And then the red dotted line should be just sitting over the 4.5% is the inflation target. We know that the SARB has a band, which is 3 to 6%, so they're targeting the midpoint. And what I would like to focus on really is those 2 periods on the gray areas here in terms of the response function of what we've seen of the MPC. So in 2022, we know that the SARB was ahead of the curve, I would like to say. If you compare it to the Federal Reserve, which was more in the transitory inflation risk that we saw, but they first acted in November of 2021, they increased interest rates. And also we had the inflation shock, which was the COVID period in 2020, and immediately what the SARB did, they noticed that there's a lack of liquidity into our fixed income bond market. So they intervened by purchasing government bonds. They also had held an emergency meeting whereby they cut interest rate by 100 basis points. So to us, we look for that level of credibility and surety from our central banks, and we do think that we're in a safe pair of hands. And what is the next thing from the SARB? They have communicated thus far, they are looking in the future, not now, into lowering the inflation target. We currently have it at 4.5%. the loveliest hawkish governor is wanting it to be at 3%. But again, this is what the market should be anticipating going forward. And another theme that I would like to touch on is fiscal consolidation. Now, I must confess, this is the first one for our market. This year, we had multiple iterations of a budget. And next week, actually, we're having a budget version 3.0 now. But there's one thing that gives me confidence, is the universal buy-in in fiscal consolidation. We know that even with politicians, different ideologies, post the formation of the GNU, there's one thing that they agree upon, which is the commitment of lowering the debt levels in South Africa because we want to grow. And what's to highlight here is a key takeaway in this gross debt to GDP chart. Even though we had multiple iterations, there is less deterioration in our debt to GDP profile, which is actually positive for fixed income markets, because what you don't want to see is that red line skyrocketing to 80%. We've seen that before a couple of years ago, so we want that contained and railed in, and this is something that all the parties agree upon. Now, the last theme I would like to touch on, for me personally, is the most exciting one, which is the trajectory of the structural growth reforms. And if there's one thing I would like the audience to take away from, and just to remember, is the name Operation Vulindlela. And the reason why I'm so excited about that. So this is a unit that is set up by the presidency as well as National Treasury. And just to side note a little bit, Vulindlela, in one of our Nguni languages, it means to open the path, is to open the road that leads somewhere. So where is this road leading us to? Hopefully 2%, 3% growth in the next 5 years in South Africa. And then, so this unit is very focused in terms of accelerating these structural reforms. So they came together, it was formed in the late 2020 with the Office of Presidency as well as National Treasury, and they are focused on 5 targeted themes. That's energy, logistics, water infrastructure, telecommunications, as well as digital for the visa reforms. We obviously want to attract very high-skilled individuals to our shores. But why is energy so important? Now, I am a South African, most like everyone in this audience, and even the people that are online. If you are a non-South African that has visited South Africa for the past 4 years, there's a little gremlin in our system that we experience, which is called load shedding. And I don't think anyone enjoys load shedding, but with the intervention of Operation Vulindlela, we've seen last year over 300 days of lights are on, business are positive, the trajectory and the direction of travel is moving in a positive way. And some of the achievements, actually, the reason why I'm so excited about this, that we should be speaking about this unit more, is the fact that they've achieved a lot. One, under the Eskom side, they were responsible for unbundling whole of Eskom units. So now we have the National Transmission Companies of South Africa, which will be solely responsible for the transmission segment in our country, as well as continuation of unbundling the rest of the business, which is generation and distribution. So I think we can tick that off for now. And then another key thing, actually one of the comments from yesterday's panel was talking about commodities, and we are an open emerging market and we do export these commodities. So we're having obviously troubles right now, shipping of the cargo to our ports. So one of the key involvements that we've seen and one of the achievements from Operation Vulindlela, one, last year in December we had the draft network statement and the release of the draft network statement, and now the latest exciting thing, which I'm definitely tracking, is that under the helm of Barbara Creasy and the Department of Transport, they have requested they put out an RFI, which is a request for information. So what that means is an engagement, it's a proposal for engagement from the private sector to actually realize that we do have issues, we do have structural issues when it comes to the logistics sector. So the reform isn't necessarily focusing on fixing Transnet, but it's more of a rehabilitation of the whole segment. And what we're going to be looking out for, obviously, is that engagement with the private sector, just to crowding in those investments. And some of the other things that OV has actually handled is obviously wanting to rein in, just to bring in skills, highly skilled individuals onto our shores. And what's so important about also this unit is the fact that it was so successful, there's a political buy-in. So it's an apolitical unit that is not aligned to anything else. It is not aligned to any other political parties. So that's what we want. That's what we look for as investors. So if there is a change in regime of administration, we know that this will continue. And it was so successful and in meeting its deliverables that last week, they've actually launched phase 2 of Operation Vulindlela, and they've added only 2 items there, which is social inequality. We understand, I think everyone understands, the level of unemployment in South Africa that needs to be addressed. And the last one would be the local government. So this focuses on the inefficiencies of municipalities. So for me, if there is one key takeaway about our structural reforms going forward, is that we need to be mindful of what this unit is doing, and we need to make sure that this unit is apolitical, is not aligned to anyone. Thank you very much.
Thank you very much.
Good morning, everyone. Thanks very much to Eugene, BCI, for the opportunity, and thank you to you, the clients. I do empathize that there's lots of other things you could be doing with your scarce time, so to listen to these presentations this morning is appreciated. World of flexible income investing, I thought this morning I'd just take a look at the prospects, both the opportunities and risks for bonds. They're an important driver of the total returns of flexible income funds, and they often are the highest contributor to volatility of return in these flexible income funds. We had a corker of a year last year in terms of total returns from bonds, and we've been through a little bit of a tougher period year to date. So let's take stock of where we are in the bond investment cycle. So as a bond investor who has been invested in this market for the last at least 2 decades, I must say the move over the last 2 decades has felt like a little bit of a roller coaster ride. And if you look at this graphic, I think it bears testament to that roller coaster ride. You've had quite elevated volatility, you've had a lot of event risks, and you've had a steadily upward moving, move in yields from lows of 6-7% all the way up to the current 11%. That's not a roller coaster ride that gives one particular confidence on the prospects for bonds and being invested in bonds. This is almost a de-rating of the South African bond market, a doubling of yields. It's like an equity PE halving. Yet if we look at the total returns delivered by bonds, despite that roller coaster ride, they've been very, very resilient and in fact quite attractive. If you look at the left-hand panel there's been quite significant compounding of bond total returns versus cash and inflation. And those are the 2 variables that these flexible income funds are largely trying to outperform, and I think that bonds have done that quite nicely. And just over longer periods of time, the gross returns from bonds against cash and inflation, you can see that South African bonds over a very long period of time have generally delivered you cash plus 2.5, and CPI plus 3.5. And in fact, over the shorter term, we've had actually outsized returns from bond yields. So what drives this? How can you get on this roller coaster and enjoy, actually come off at the end and actually feel glad that you went on it? And it's the yield on South African bonds. And this is the irony. It's a little bit of a Jekyll and Hyde existence in bond investing. The worse the backdrop has got in South Africa, the higher yields have got, and the more you've been protected from a total return perspective. So yields are giving you a big fat, and Phil mentioned it, a big fat buffer against cash and inflation of outsized proportions that a lot can go wrong before you start to underperform or get close to the performance of those 2 variables. So the opportunity is the level of yields. Yes, if yields do move and you get a rally like we had post the GNU and you get some capital gains on top of elevated yields, that's a bonus. But it's the level of yields and that income accrual that is the opportunity in South African bonds and has driven some of the outsized returns from flexible income funds. So from a domestic investor's perspective, on the left-hand side, if we look at the gap between bond yields and cash, that's around about, and this is where old age kicks in, it's about 3.5%. It's not as high as the highs in COVID, but we had the outsized monetary policy easing in cash rates, but it's substantially higher than what we used to get relative to cash prior to COVID. And the right-hand panel shows you the gap between bond yields and inflation, and that is at an incredible 7% real rate of return at the moment. So there's no doubt that the level of yields are incredibly high. If you look at it from an international perspective, the left-hand panel shows you the gap between our bond yields and US 10-year bond yields. And while that is also not at the COVID highs, it's at a very, very healthy sort of 6.5% if you're an international investor purveying the opportunity of entering South African fixed income or bonds. On the right-hand side, something that we've become accustomed to and that we all know quite well, within the emerging market universe, our yields are very high and very competitive. So both from a domestic investment perspective relative to cash and CPI, as well as an international perspective relative to the global risk-free and relative to other EM peers, there's a very, very attractive yield opportunity, and one that is pregnant with protection against volatility, against that roller coaster ride, against the event risks that our world is full of at the moment. So, big fat yields from bonds, what are the risks? What are the risks that yields continue to go up and that roller coaster ride continues and that it becomes more embedded in the system and that it starts to detract from returns, it starts to take away from these elevated yields that investors are earning in the portfolio? So to analyze the risk, we break bond yields down into these components. And if you have a look, the basic one that you start with is, it's not projecting on the screen, is the US 10-year bond yield in orange, plus the South African country risk premium in dark gray. And then everything else that is left is known as our risk premium or our domestic risk premium that investors are being paid for investing in bonds, that light gray portion of the yield that a bond pays you. And you can see it's that light gray portion that has largely expanded and widened over the last couple of years and caused our bond yields to move a little bit higher. And that incorporates a lot of the domestic risks that we all seem to be worried about, that you guys seem to be worried about, because I have a lot of calls about fiscal sustainability on our government bonds and the dreaded D word, could the South African government default? So when we assess the risks, there's not much we can do about US 10-year bonds, out of our control, but there's a lot we can do about that risk premium, that light gray bar. And if we zoom in on that as a precursor for what could lie ahead for us as bond investors, I think Phil made this point as well. There's no doubt that policy uncertainty is very elevated. On the right-hand panel is the policy uncertainty index from NWU, which is quite useful, and you can see it's at unprecedented levels in terms of people's angst and nervousness and uncertainty. But if you have a look at that grey portion of our yields in that left-hand panel, we're slap bang in the range of where we have normally kind of traded. That 3 to 4% yield or risk premium that is embedded in our bond yields has sustained, and we're right in there at the moment. So one could look at that in two ways. Either bonds are being too complacent in terms of pricing the potential risks and what's coming down the pipeline, or they're showing that resilience and they're well priced for the risks that are currently complicating our investment backdrop, should we say. So that grey portion of risk can essentially be broken into two elements: inflation risk and fiscal risk. So if we have a quick look at both of those. Inflation risk, we're not too worried about in terms of influencing or driving bond returns going forward. The left-hand panel shows you the difference in the tracking error from the All Bond Index, which is nominal bonds, and the iGov Index, which is ILBs. And as that compresses or comes down, it tells you that the market is quite complacent on inflation. There's not a lot of concern on the inflation outlook. And you can see how that's come down substantially as inflation volatility has come down. So not only is inflation low, but it's also got very, very low volatility at the moment. And what's happening in the economy and in the market is gradually inflation expectations are becoming more and more entrenched at lower levels, and this will ultimately allow us to move to a lower inflation target, as Shwebi has sort of highlighted. And so that has really taken the risk component of volatile inflation out of that bond risk premium. Now, just things to watch going forward from an inflation backdrop. it's a little bit topical as to how inflationary tariffs are going to be. We're increasingly of the view that that's a US problem. The rest of the world looks a little bit like it's in a deflationary cycle. And if you consider the fact that the rest of the world's currencies are not really weakening against the dollar, which everyone thought would happen in response to tariffs, plus you add things like slowing global growth, fall in confidence, fall in sentiment. You take into account the fact that the Chinese are exporting a lot of deflation and are likely to continue to do so. You add a falling oil price, and you add in, the AI productivity contribution. We don't think that there's too much inflation risk in the system, and we don't worry about inflation risk premium in that portion of our local yields. The thing we worry about more, and the thing that will drive that portion of our yields, is our fiscal risk. And if you look on the right-hand panel here, our government debt servicing costs relative to other emerging markets and relative to the developed world as a percentage of GDP are off the charts. And it's not necessarily that we've got a big outsized debt burden. 75% debt to GDP is not particularly high relative to other emerging markets, and certainly relative to some of the developed world economies. Our problem is the combination of low growth and very elevated yields makes servicing that debt burden extremely pressurized. And if you have a look, we spend almost 6% of GDP on servicing our debt, where other emerging markets spend 2%. So it's the cost of servicing that debt that is strangling us and suppressing us. The second part of the fiscal problem that we do worry about is the maturity profile and the refinance risk that is facing the government. They generally borrow around 300 to 350 billion rand in the bond market every year. In addition to that borrowing, over the next few fiscal years, they have a number of years where they have to mature or refinance 300 billion rand of maturing bonds. Some of the big benchmark bonds are coming up for maturity. Now, the view is that, or the theory is that investors that are in those bonds already will just refinance and move to longer dated bonds and will kick the can down the road. But those are incredibly outsized refinance burdens that are due in the next few years that they are trying to manage their way out of, and that is putting some upward pressure on our yield. So what are we looking out for from a fiscal risk perspective? It's not so much the size of the debt burden, although we would be very relieved to see that stabilize and almost come down. It's more the cost of servicing that debt burden that is overly exorbitant at the moment, and it's the refinance risk of the incredibly high level of bond maturities that are coming down the pipeline at them. You add now the downside risk to global growth that is going to make refinancing as well as the revenue minus expenditure gap come under a little bit more pressure, and you have a particularly precarious fiscal position, and I think that's been reflected in our bond yields and the steepness of the bond curve. Now, what gives us a huge amount of sort of comfort, if you like, or optimism is, and I think Shwebi alluded to it, there is certainly in the current policy-making regime, even though it's incredibly messy, the way they've run the thing, there is a desire to fiscally consolidate. There is a desire to get this under control, and we would look for these local growth and policy reform initiatives to help in terms of managing the debt burden, but also very importantly for them to start to talk about and actually announce formal fiscal anchors and spending review frameworks that would ensure fiscal sustainability going forward. So we look for that to come in MTBPS and perhaps into the budget for next year. That is absolutely vital to consolidate this fiscal burden and to make sure that that risk premium in our bond yields does not continue to widen and continue to go more. I mean, some event risk along this fiscal pathway, it's important that we get ourselves off this grey list later in the year. Unfortunately, there's been a deterioration in the international relations position with the US, and I think it would be very important that that doesn't culminate in sanctions of any sort against SA or any of SA's leaders. And just when we started getting going on the sovereign credit rating and had the potential for revisions to outlooks and maybe even upgrades, we've got hit by this left field decline in global growth, which is going to make things very difficult. But just to sum up, although the backdrop is uncertain, and some of the policy uncertainty is almost unprecedented that we're facing, there's a huge shock absorber in our yields, and there's a resilience to our bonds that has coped quite well with this type of environment in the past. Is the future going to be the same? One would hope so. We think that bonds are resilient, and that resilience should continue, and that should support quite elevated returns within the flexible income universe over the remainder of this year. I will stop there. Thanks, Pierre.
Thanks, Conrad. I'd like to commend the speakers for their time management. We well ahead of time, so we've got some time for questions. Well done. You probably want to get back to the Bloomberg screens, I know, but anyway. I'll check whether there's online questions. Any questions from the floor at this stage? There's one, two at least. Sean, Mike, please. Roaming mic. Just put up your hand, sir, please. Or, is there a lady? Maybe the lady first, Sean.
Let me stand up. Thank you so much, guys, for the presentation. I thought it was really insightful. For the panel, I'd like to maybe get your view on how would you rate the SARB out of 10? Because when you go back to it, fundamentally, fiscal consolidation, debt burden, fiscal anchor, reform, recovery, all basically comes from them. Thanks.
Maybe I can kick off. So I think let's just take it one step back and understand what is the mandate for the South African Reserve Bank. So the mandate they are it's monetary policy. So the fiscal anchors lie more on the other side. So the mandate is to manage inflation, and obviously keeping, as Philip said earlier, the rand in place. So if I were to rate, let me just answer your question first. If I were to rate them, I'll rate them highly. If I were to give you a number, call it 8. It's definitely on the highs, because we cannot lose the fact that this is their mandate. They cannot go outside of that scope. And have they achieved, I think the question maybe we can direct it as, have they achieved what the mandate states? They said they've got the inflation band between 3 to 6%, and this is our target of 4.5. How is that 4.5 in the previous chart that I showed? How have they performed? And what is the future inflation expectations? Are those anchored? So that's what drives the South African Reserve Bank for me, so which is why I rate them quite highly.
Could I play devil's advocate?
Go for it.
Inflation is below the bottom of the target, and our growth is below equilibrium or trend growth in the economy. If they're not cutting rates now, when will they ever cut rates? So I absolutely agree. They've been a fine, upstanding institution. I worry that they are ultra conservative at a time when this economy needs some heavy lifting. And be careful what you wish for. They cut, and we could. But I just don't see a big demand problem. I don't see a big inflation problem. And I worry that if not now, then when?
I tend to agree with that. Yeah. Thanks, Conrad. And thanks, Ruby. Good insights. Another question? Sorry, I'll move on to the next question in the interest of...
Philip, Conrad, I think we're fighting from the same side, that bonds are the place to be. So my question would be around, let's be gentle to the equity managers. If you have to take a view 3 years and advise asset allocation or these sort of flexible funds, how large a portion would you advise funds to have in bond exposure?
Yeah, I think
I know.
Well, I manage multi-assets as well, and always have. So I think more than you would normally have, and for a couple of reasons. One is we touched on it earlier that if you're going to model your asset allocation sort of data that's in the history, that history has an inverted yield curve where bond yields were lower than they are now, and cash was higher, sort of thing. So it's kind of looking backwards, but that's not how things are positioned. So we're in a situation right now where absolutely the real yields that are locked in within bonds are actually probably higher than your mandate your mandate. So like your average balance fund is typically, it used to be inflation plus 6, so they lowered them to inflation plus 5 a few years ago. And when you're locking in those sort of yields, what are we, inflation plus 9 at the moment? The short answer is more. I was running a pension fund a few years ago, and I got into exactly this debate. I see Carl in the audience there; he knows which one it was. And I was told by the asset consultant that because I went too overweight bonds, that I was being irresponsible. But when bonds were giving you inflation plus 8 or 9, and your mandate's inflation plus 5. And it's very reliable, definitely more. The thing to appreciate, though, is that South African bonds and South African equities are both risk-on assets. So equity, bonds, property, etc. So US Treasuries in a normal world are a risk-off asset. So they'll tend to do well, as an example, when things are bad. But South African bonds will do well probably in the same environment where SA as an economy is doing quite well, and property and the likes. SA equity is obviously a bit global. But the point is the movement into bonds is not a risk-off cop-out. It's actually an asset that will do well in the environment where the South African economy picks up. So in an environment where South Africa improves, the economy picks up. Ironically, inflation starts picking up for good reasons in South Africa. That's when bonds will do really well. But most importantly, as an investor, and we're sitting in a casino here, by the way, and when you're in a situation where I think if we are wrong about bonds, as I've shown, I think we've modeled with dynamic income, if we're really wrong, we'll probably do 9. If we're really wrong, we'll probably do 6 over 12 months. That we can live with, and over 3 years, closer to 10. So I think the nice thing with bonds is not so much will they do better than equities. I think in the environment where bonds do badly, equities will do very badly.
I do echo Philip's sentiments here on this one, because it's going to sound like a biased answer, obviously. I would be overweight bonds in the next 3 years. So as risk managers, we have to think, okay, what are we getting from bonds, right? We're getting 2 components. We've got the income component that you know that you're locking it in, and then you also have the capital movement of your bond positioning. So as Philip mentioned, in the worst case scenario, equities will perform badly, and then you've got your bonds kind of like steady as your security in a sense. So I would be definitely overweight bonds.
Thank you.
Sorry, can I just add one more point to that?
Yeah.
As what we did in our asset allocation is we increased SA bond exposure a couple of years ago at the expense of SA equity, but we used that then to go more offshore. Because the offshore equities, in the environment where offshore equities do badly, the rand tends to weaken, so it tends to smooth that out. So I always think of asset allocation like a Rubik's Cube here. You're not just trying to solve for one end, you've got to realize the interplay between them. And I think SA bonds, probably if you are going to decrease equity in South Africa, you probably need to look at something outside of South Africa then, in terms of your alternative for your equity exposure.
Thanks for that. There's an online question, Conrad, for you, that says, everyone is concerned about servicing government debt. I think it means everyone in government is concerned about government debt, yet massive rises in government services to the public, meaning administered prices, are not deemed to be an inflationary concern. Please comment.
They're trying to solve a puzzle at the moment with a lot of different pieces. I think the current sort of budget mess, if I can put it like that, is evidence of this, where there's so many moving parts that they need to get together. What is disappointing and frustrating is the parts where there are low-hanging fruits that they can cut. There seems to be a very strong reticence to cut, and it's going to be interesting to see what comes out in version 3 now, in terms of making the important and the brave decisions. I think on administered prices particularly, it's not all bad news. Those have come down quite significantly. They're nowhere near the levels that they need to be in order for us to, deliver sustainably below 3% inflation, like the inflation target sort of regime will need to do on a consistent basis. But they have come down quite substantially. I think sometimes we get caught up in the headlines of the main ones that we all like to quote here, medical inflation and educational. But within the broader basket of administered prices, there are quite a number of them that have come down and have been dragged down by the reduction in pricing power in the economy. And I think breaking the back of that administered price sort of little inflation hump will be part of the solution in terms of getting sustainably lower inflation in South Africa. But it's going to take, fairly bold and fairly, unusual policy making, which the guys have yet to prove that they've got the stomach for that.
Thanks for that. Conrad, I want to stay with you with a question from me. I want to return to the topic of credit that I touched on in my introduction. And the question is, and maybe the question is about the size of the credit pool in South Africa, but my question is, many of our clients invest into a number of funds that have meaningful credit exposure. And the question is really, one worries about the overlaps and whether all managers exposed to credit pretty much end up with all the same stuff. So the question is, is it paramount that one must diversify across funds when you invest in want to invest in credit or funds exposed to credit? And is that diversification effective in South Africa, in your opinion?
Yeah, Pierre, so the challenge from a credit investing perspective over the last good few years is that the market is narrowing and shrinking. So the number of issuers who are borrowing in the bond and capital markets has declined. Also, what you find sometimes is the guys who need to borrow are the guys you don't really want to lend to. And we've seen that with the SOEs, for example. So I think it's pretty likely that the flexible income funds that invest in particularly listed credit are largely holding the same stuff. The market is not broad enough and growing enough and diversifying enough for that to come through. However, I would sort of just counter that with where you're getting the breadth and the diversity and the new opportunities is in the private unlisted credit market. And we're particularly prevalent in that space in the Alawani BCI High Yield Fund. And there I think that's where you're going to find the unique exposures, the specialist exposures, the exposures to new sectors of the economy and new growth areas, and get a little bit more of that diversification.
Thank you.
Okay, just a comment, I think, on, what do we mean by credit? So, bonds or loans, and you're either lending to government or you're lending to SOEs or companies. So anything almost outside of government would be a type of credit, as we would call it. So, and normally, why do you go into credit? Well, because government interest rates tend to be the lowest in the country because it tends to be the best credit quality. And then you go into credit, you lend to lower quality borrowers to get a higher yield. The crazy thing in South Africa, though, is that there's so much money that's chased the corporate credit spreads. In other words, the yields you're getting from the corporates to such low levels that in many respects you're getting higher yield from government. And if you're prepared, and the thing is, all your corporate bonds, your corporate credit tend to be like 3 years, maybe 5 years if you're lucky, because you're not going to lend them companies money for 10 or 20 years. So actually, if you're prepared to put money into a 20-year government bond, as an example, you're getting a much higher yield than you are if you're lending into the credit space. So I think it's a tricky, in my opinion, and in terms of how we position, probably our worst credit quality we've got is the major banks, which we're all kind of happy with. So we just find right now that there's no need to go and chase credit risk if I can get, sort of inflation plus 8 out of, or inflation plus 9 even out of a government space. So it's really, I think, when you're going into credit, you want to make sure you're getting additional yield. Otherwise, why are you doing it? And it's really a case where the best yields right now are coming, ironically, from the lowest credit risk assets in the country.
Thank you. We've got 2 minutes to go, so let's speed up. I thought we were going to end with 3 fun questions. Is there a question on the floor? Okay, go there.
From me. Conrad, you mentioned concerns around the maturity profile of SA government debt. as well as the refinancing risks. When you look at that, I mean, we've seen government with the switching program, there's not been a lot of attraction towards the long end of the curve or back end of the curve. I just want to find out, are there certain areas of the yield curve that you are deliberately sort of avoiding? And has this impacted your sort of duration positioning in your funds?
Thanks for the question. It's the first time anyone in the audience has ever known what a government switch auction is. So, I don't know if you're planted from a question perspective. That's awesome. They're trying to manage these big refinance risks by switching out. So they'll buy back these shorter ones and issue you longer ones in advance of the maturity. So they don't have that big fat maturity to pay back. And what this has done is the market goes, okay, well, there's 300 billion a year coming of all these maturities, and we know that they're switching into longer ones, so the market almost steps back, and the longer end of the curve has just got higher and higher and higher, and steeper and steeper and steeper. So we've been avoiding that ultra long end for quite some time now, as it's got steeper and steeper because of this switch auction dynamic, but also because of that risk premium getting wider and wider. But there comes a point where you go, to what I alluded to is what's in the price? Are you not getting compensated and paid enough? And the one sort of left field thing I would just throw in why we are starting to think that perhaps that ultra long end might offer really, really decent value at 12% and higher is we think there's a good chance that they go and get a chunk of their borrowing and a chunk of their funding from non-conventional sources over the next couple of years. So they raise the energy transition finance, they raise developmental finance, they raise concessionary finance from a variety of non-traditional lenders. And if they can do that in a significant portion of their borrowing, it doesn't reduce their overall debt burden, but it brings the pressure on the bond market down, and the pressure to do these switch auctions and the pressure on that ultra long end of the curve down. So there's a way to go here. It's still very precariously positioned, but at a level where you are, as Phil said, 5, 6, 7% higher than cash yields in that ultra long end, it starts to look like one should have a little bit of a dabble there maybe for the first time in a while, is the way we're seeing it.
Thanks, Conrad. Any last questions from the floor? There's one. Last one.
This is a question to the panel. The one issue I always find is South Africa is like a story of two parts. One, we can be almost a first world. The second, we third world. Now, let's go back to the credibility of the government. Isn't that the major problem? Because if we look corruption, mismanagement, accountability, enforcement, why can't they just try and take a leaf out of the best companies managing South Africa? And perhaps we can reduce the size of government and the amount of money that goes into corruption and mismanagement could definitely improve our position. I'm just a question.
Very quick comments, we're out of time.
Yeah, I mean, essentially that's why our bond yields are 11 and 12 and not 8 and 6. So the sad story is when we were showing earlier where bond yields were sort of 4% below cash as we were running a fiscal surplus. We weren't spending a lot. So the irony, the reason the country's such a mess is because of all of that. But the reason we're actually able to lock in as, let's call it capitalistic investors at these high yields is you're actually taking advantage of it. So unfortunately, there's nothing we can do about that rather than, as investors, just play the cards that we dealt. And right now, I think the cards are, the hand that we've got is skewed in the favor of decent returns.
Thanks. I think we'll need to conclude it there. Thanks,
Thank you.
presenters. It was quite lively. Thank you very much. Back to you, Eugene.
Many thanks to our team and Pierre for making for interesting conversation. Pierre made me think about those Chomp ads. I don't know if you can remember it. There's "Oh Groot Bek," those two hippos, right? Maybe they should rerun that ad with Trump. And yeah, exactly what you mentioned on all the thievery in the country, or we can actually start Chomp Awards. And I'm sure the first names that will go into that hat is some of our very lovely politicians. We are going to break now, Phil, for tea till about 11:10. We will sound the bell as soon as we need to come back in. Enjoy for our online audience. I'm sorry. Right. We'll see you back here at 11:10. Thank you. Right, thank you all for being back in time, and welcome back to our online audience as well. Just before we get going on global equity, I've got our panel ready on stage to be moderated by Rudolf Horn, Director and Portfolio Manager at Miton Optimal. Rudolf, you can introduce your panel and the topic. Thank you so much for joining us here this morning. We really appreciate it. Thank you.
Thank you. Môre, hoeveel blou bulle is hierso? Hande op. Nie genoeg nie, hè? Nie genoeg nie. But it's nice to be in Pretoria, and thanks to Robert, Tanya, and the great BCI team and Apex for providing us this opportunity to be with you and to hopefully add value in terms of the speakers and the questions that we will address today. Miton Optimal, well, we celebrate 25 years as a DFM today, and I think if you ask me, what did I learn over 25 years? Assisting financial advisors and creating wealth for investors. Diversity of investment styles, and that includes indexation as well as alpha managers, and a diversity of asset classes through the cycle. Trust me, over 25 years, it works. Over to the speakers. We today have Balondolozi Investment Services, Faniel Tegere representing them as the Chief Investment Officer, Philip Short, a Global Fund Manager of the flagship Worldwide Flexible Fund, and then Tony Bell of ThinkCell, experienced team, and Tony has come a long way in this industry and has earned a lot of Raging Bull Awards, if I can promote that. And the topics that they're going to address are, first of all, Faniel, in 2022, both global bonds and stocks declined. Could this happen again? And next on stage will be Philip Short, navigating volatile markets as to how they do it in that Worldwide Flexible Fund. And then Tony is going to entertain us on understanding the rotation in equity markets and the impact of a potential dollar devaluation. So without further ado, Faniel, over to you.
Morning once again. My task should be simple, answering the question, but as we're discussing with Rudolf there is, you'll find that the agenda was drafted in Feb. I think March and April answered my question. So I'll start off from broad macro in terms of equity, then see the opportunities within equities, then the risks attached to harvesting those opportunities, and then just in a sort of opinion on how you can balance the risk reward as you're chasing alpha in equities. So bear with me as I go through about 8 or so slides in my presentation. So who we are, I'll just spend a few seconds there. We started off in 2010, started operations in 2011. We're a quant house, focused on macro and combining that with bottom-up fundamental analysis as well. We manage about 15 billion over 4 broad strategies: multi-asset, equities, fixed income, and cash. You'll find that in terms of our ESG, giving back, you'll see the other parts on our slides. So I'll go on to just look at the valuations. You'll find that this is at the end of March. You'll find that the valuations were quite high after COVID in 2021. And then with 2022 correction coming through, there was a rally from 2022 until late last year and Q1 this year. So if you look at global equities, represented by the MSCI All Country Weighted Index, the valuations have corrected. They're close to their averages. Same thing with the US equities that were frothy as well. They're closer to the averages, and the emerging market represented, or the MSCI All Country Weight, excluding the US, is also below the averages. So the opportunities are there in the in the global markets because valuations are permitting. But one thing that was a big issue last year was that you find that the expectations for the growth expectations or the PEs of the Magnificent Seven or the tech stocks were quite high. So I've got a chart here that shows the PEs combined of the Magnificent Seven and compared to the rest of the MSCI, the all-country weighted stocks in there. So you'll find that on average, the PE of the Magnificent Seven was about 1.8 in terms of ratio, and that average, you see, after the correction in Q1, we're below average. If I can even say it's as low as it was at the end of 2022. So in terms of there being a risk for that big correction, we are past that. The market is healthy, and again, as an asset class, global equities presents opportunities even outside the US. Then the other bit that we look at as well is, as a house, is just the intersector correlations. In case you are playing sectors, IT versus financials, resources or materials versus other parts of the indices. So if you find in general the sectors are related, so the correlations in between equities is about 0.6. If it's 1, that means they are 100% correlated, they move in line. If it's 0, that means they are not correlated. So in this case, you find that right now the correlations are as low as they were as we went into COVID. So in terms of active investment within global equities, the opportunities are there because the correlations are low. And in terms of, again, equities as an asset class, like I said, the valuations allow us to do that. So the next slide, again, we just show the dispersions of returns. I'm just looking for a research, I think that was published for 2024 S&P Dow Jones, the index. We're looking at the dispersion, looking at the differences per month of the returns of the highest returning stock versus the returns of the lowest returning stock. So the purple line shows the global equities, and you find that the orange line, they show the domestic, orange and green line, they show the domestic indices, again, S&P Dow Jones indices. So globally, again, you see that the dispersion is quite high between the highest returning and the lowest returning. You're seeing by the line that's quite high up there. In the local equities, there's still dispersion, but opportunities are abundant within the global equity space. And again, just looking at the dispersion, looking at 2024 returns, how sectors have performed, I'll just focus on the purple line, which shows the returns of sectors within the S&P World Index. You'll find that tech, Magnificent Seven, at the input that's within the global equities managed in South Africa using the Morningstar surveys there. You see IT, information technology, it contributed the most in terms of the returns, and compared finance and telecoms as well. So that means if you are an asset manager, you miss the tech because of the valuations, again, your returns might be expected to lag the benchmark there. So as we see that there is dispersion, in my next slide, I've talked about the valuations being supportive of global equities. I've talked about the correlations being low, as in the opportunities to play sectors within the global equity space. We've also said there's opportunities again for someone who picks the right asset to be able to extract value. But looking at the survey again from compared to the S&P Dow Jones, it shows 5 groups. I'll focus on the global equities. There are 5 groups of funds that are within the unit trust space. The first group being the local equities, and the bar charts just represent the percentages, the percentage of funds that are underperforming the benchmark, the S&P Dow Jones World, if it's global, the local ones, if it's local S&P index if it's local. So the first bit, the 1 year performance to my far right, it shows that 20% underperformed 1 year performance for the local equities. Then over 10 years, it shows that about 90% of the funds, this is net of fees, and again, the disclaimer is the benchmark that we're using here is the S&P, the local benchmark. Then if you go on the global equities, the funds that are domiciled in South Africa, that's the middle set of bars there. It shows that over 1 year, about 90% compared to the S&P global index underperformed, and over the 10 years, again with the disclaimer, against the S&P benchmark, most of us use the MSCI. But what I'm trying to show here is that with the opportunities that are in the global index, global equity space, within sectors or across sectors, across geographies, you'll find that it's not as easy after expenses, whether it's index or whether it's active management. So as you are trying to construct your portfolios, you also want to take into consideration that the performances at times might lag the index because of various sectors, either correlation or the fact from last year that the set or the sector that was driving performance was quite rich in terms of valuations. But before I depart from this chart, I also want to highlight one of the issues there. That you'll see that of all the sets of bars there, you find that short-term funds domiciled in South Africa are the ones that seem to outperform consistently, judging by the underperformance that's muted over 1 year. You've got 95% of the managers in short-term bonds that are only 5% are underperforming. That means 95 are outperforming. And then over 10 years, you find that about 75% are outperforming. So as you are trying to construct portfolios to have exposure in global assets, I think you want to balance this. And one way to effectively leverage the outperformance that we are seeing in the short-term funds, and to also avoid the possible underperformance in the global funds domiciled in South Africa, one of the strategies is to do a global portable alpha. Then sorry for that. The anatomy here is if you combine cash and the future, you simply get the return of the index. But what the global portable alpha tries to do is then put the alpha from the cash that we've seen has got better odds of outperforming, combine that with the future, and you've got your index return, whether it's MSCI or country-weighted index, and you've got your alpha there. The odds of outperforming are better compared to, again, active or just trackers. In that, obviously, it comes with further risks, but again, the outperformance that's coming from the short-term money market managers is what we're trying to harvest here using the portable alpha. So in a nutshell, there are opportunities in the global markets. As an asset class, there are opportunities in terms of intersector correlations that are low. Again, as you try to harvest or to get those opportunities, we think we need a portable alpha strategy to be able to have exposure to the global equities and have alpha that's more consistent using the short-term bonds. And we do that by just combining cash and futures. I think that's my story, Rudolph. Yeah, I'll leave the other panelists to add to the global equities.
Thank you, Faniel.
Thank you.
Thank you. Well done on time as well.
Yeah.
Philip?
Morning, everyone. I'm going to give you some insight in today in terms of how we look at markets. We basically manage global markets with Global Equity Fund and the flagship Worldwide Flexible Fund, and I'll be touching on the Flexible Fund in these slides. So I think the data seems a little bit different to what Faniel had. Maybe it depends on starting and ending points. But this is the MSCI All Country World Index. It's the forward PE, the blended forward PE over the last 20 years. And we had to submit this presentation about 2 weeks ago, and the forward PE of the ACWI was sitting at about 16.4 times. I checked in this morning, it's now at 18.1 after a strong run after the tariff talk, with a long-term average, or the median, with the 20-year median sitting at about 14.5. So we're looking at spot forward PE at about 23%, 24% above long-term median. Looking at our asset allocation starting on the left-hand side, January the 1st, 2025 versus 31st of March 2025, 2 days before the infamous Liberation Day. This is just displaying how we changed our asset allocation. The main change was equities bringing down from 87% to 73%. Not a major change, but what's it, about 14% decrease in equities. And within that was a reduction of US equities from 53% to 38%. And an increase in cash to 20%. And then we have cash in different areas, US, Japan, Euro, not so much in South Africa. So let me just go back. So why the change? So on the previous slide, I showed you that the markets are pretty expensive. They started somewhat expensive, but now they're pretty expensive. But we never look at valuation in isolation, because markets can stay more expensive for longer than you think, and for good reasons as well, such as strong earnings growth and lower global interest rates. So but prices are more sensitive when valuations are cheaper or more expensive. So we do tend to look for signals to see where the valuations are heading afterwards. So it's a couple of signals, and there will be a lot of signals that we look at, but I've just highlighted 3 here that are worth mentioning. So the new US Treasury Secretary, Scott Bessent, came in and made a couple of announcements in Q1 of this year. In short, he was saying the economy in the US will slow in the Q1 this year as they cut back on government spending. Cutting spending from a 6% GDP to a 3% GDP equals about $1 trillion less in spending. However, I have been tracking the year-to-date spending of the US government, and they haven't cut back as yet, but that is where they're looking to go, to cut spending from 3 to 6% GDP. He's talking about cutting the government spending because it was too bloated during the Biden era, and that one can expect a hangover in terms of cutting back expenses. And he's putting the first 6 to 12 months of blame on this year's economy purely in Biden's corner, and after that, it will be Trump's economy. So a bit of a kitchen sinking going on at the moment. And then importantly, I mean, there's obviously the private sector as well, and what they're trying to do is firstly decrease government spending, and then increase private spending, but it won't happen simultaneously, and so there will be a soft pocket of weakness in the US economy for this year. The University of Michigan does surveys in the US on a regular basis where it asks consumers and businesses questions like how they think the economy is going, etc. And one of the questions on US consumer sentiment showed that sentiment sort of came down quite sharply in Q1 of this year. Consumer and business inflation expectations jumped from 2.5% to 4.5% expected for the next 12 months. Consumers expect change in real income to decrease, and businesses expect business conditions in 1 year's time to sharply decrease. These are soft data, and we'll never act or make asset allocation just on soft data, but it is part of putting the whole picture together. This one is earnings estimates for the underlying companies that make up the aggregate ACWI, and we've seen a decline in earning estimates for 2025, starting all the way from April 22, with a sharpish drop-off coming from October 2024. The line is negative, but it's not significantly negative. It's about a decrease of 5% in earnings estimates. Prices do tend to follow earnings, so this was another signal for us. You would have noticed that we invested 7% in gold bullion, no gold equities, but in gold bullion. The most important reason for us, and it's structural in nature, and it started in 2022, where we think gold has overtaken US Treasuries to become the global, truly risk-free asset. What happened in 2022 was Russia invaded Ukraine, which in itself is maybe a short-term bounce for gold, but the structural reason being is that after the invasion, the US froze all Russian foreign reserves, and that includes US Treasury holdings that Russia had. Once they froze those reserves, that meant that Russia could not get a coupon or a yield on the US debt that they held, and they couldn't sell any of their US Treasuries that they held. In theory, this was a freeze of Russian assets. In practical terms, this was a default, which is very important given that the US was seen as a risk-free, US treasuries were seen as a risk-free asset. So even though the US is able to pay their debt, they weren't willing to. And this for us was a big red flag. And you could see at that time, countries like China, Brazil, and Saudi Arabia started selling down their US treasuries because they would also be at risk at freezing their US treasuries being frozen. And central banks globally started buying gold. The other factors that I'm going to mention are more tactical in nature and could drive the gold price up or down in the short term. But geopolitics, safe haven, trade wars, potential stagflation, and diversification. Although worth noting, in the last 2 years, there's been a strong positive correlation between the ACWI/S&P 500 and gold. So our thesis on this will change the moment that we feel that gold is at risk of being the global risk-free asset. We also hold 0% in bonds. So if we look at US debt particularly, the US is on an unsustainable fiscal framework when it comes to debt. Now, I know it sounds simplistic, but when you are buying a bond, you are literally lending somebody money. And if we look at the US, for the first time in history, in early 2024, the US had to borrow money, not just to pay off existing debt as it rolled over, but it had to pay the interest on that existing debt. To put it in practical terms, if you and me had to have a credit card and we maxed that out, and our income couldn't pay for the interest on that credit card, we'd have to get a second credit card to pay for the interest on that first credit card. Obviously, the debt's going to rack up on that second credit card to the point where we can't afford the interest on the second credit card either. Hence, we'd have to get a third credit card. So that's a problem for us. It's difficult now to price bonds, and I'm not saying we'll never invest in bonds. Of course we will, but it's about the risk premium that's attached to US bonds. Inflation in the last 2 weeks has actually become less sticky. The problem is that people are maybe looking forward to tariffs. There's been a bit of a ceasefire, and there could be a one-term effect in the increase in tariffs. But there's less inflation fear that I can see in the last 2 weeks in the short term, other than the one-off uptick in tariffs. Political interference, Trump has tried to interfere with the Fed, but it has been limited. This is where we find it challenging is to find the right risk premium that we attach to US bonds at the moment, and what yield we'll be comfortable holding. And also, also now with the default, the practical default of US debt with Russia also affects that risk profile. And then, in our opinion, SA is priced for happy days. Yes, our real rates are very high. Yes, the central bank could price lower interest rates, but from a political aspect as well, the GNU is in fact priced in a status quo. There is a political risk for us that if the GNU does fall apart, that the yields go up further. So what we're watching, inflation, I think everyone will be watching inflation and US bond yields, rate cuts, maybe rate hikes, spending efficiency out of the US, debt to GDP ratios in the US currently sitting at about 130%. And this is the positive outlook that might happen, or that we think it will happen under Trump's 4 years. So the Fed balance sheet has been doing QE all the way up to, from the GFC up to 2022, and expanded its balance sheet, pumping money into the market, and which has ended up at about $9 trillion on the Fed's balance sheet. Since then, we've had quantitative tightening, or QT, which has brought down the balance sheet, or has actually withdrawn a bit of liquidity out of the market, and that's sitting now at $6.7 trillion. That does give at least a $2.3 trillion capacity for QE whenever Trump feels that he needs to, or the Fed, to pump money into the market. However, inflation would have to be under control before he can do that. And something that we've been thinking about lately as well is the positive effects, even if it's a once-off, that the tax cuts, the US corporate tax cuts, could be coming as soon as July in the US, which could see an increase in EPS revisions or estimates, earnings estimates coming forward. So last slide. In the flexible strategy, our priority is to protect capital, and after that, to generate inflation-beating returns. That's how we think about money in terms of the flexible category. Our funds are equity-centric. Over the long term, equities are the best performing asset class. So in the flexible fund, you can expect our equity holdings to be anywhere between 60 and 95%, with the rest being made up of bonds, commodities, cash. Unconstrained, like other flexible funds, and why we like it versus balanced funds, is that it's truly unconstrained. You can hold 100% offshore, you can hold 100% in equities, you're not constrained by any sort of Reg 28 constraints. We're very nimble, we're a small boutique. If we see an opportunity today, we can do the research today, we can look at all the pros and cons of the research today, and we can execute today. Having worked in larger asset management before, it really is a real quiver, or a real tool to have. We're truly global. Our first fund was in 2001, so we're almost 25 years old as a firm. We started off as global, we specialize in global, and it's something that we think differentiates from our peers. And yeah, so we started in 2001, 25-year-old fund. That's it.
Thanks, Philip.
Good afternoon, ladies and gentlemen. Thank you to BCI and thank you to yourselves for your time and your participation. Very brief introduction. We've had the pleasure of running the MyPlan Global Macro Fund for 13 years since inception. It's given a very credible return. And as the previous speaker said, the real focus here is flexibility. How do we generate the alpha? How do we manage the risk? So what I want to do today is not share with you the much spoken about Trump agenda. I really want to try and unpack for you how we see it and how we fitted it into the asset allocation, the stock selection, and the sector selection decisions that we've taken, and really give you a framework to take away today to think about the next 3 and a bit years. We all know that Trump is very chaotic. That's on the right-hand side. But what I direct your attention to is the 2 bits on the left-hand side. Project 2025, Heritage Foundation, Washington. We've heard Trump drain the swamp. This is a 960-page document that tells you how he's going to drain the swamp. I'd urge you to download it and read it. It's very important because it gives you a framework of where Trump's thinking is. This graph shocked me a little bit. It was done recently by the World Value Survey. And what I wanted to try and understand was the positioning. How we've moved from the top left, Democrats, late last year, US left, down to bottom right. And I think what shocked me in terms of the positioning of Trump in the axes of more global, more isolationist, more liberal, more conservative, was just the extent of the shift. When you see Trump in the same camp as Erdogan and Putin, you've got to stop and think for a moment. This is more right than the Italian right. This is more right than the French right. This is more right than China. So when you put that together with the Heritage Foundation Project 2025, you get a blueprint as to where this is going. And it's a different world completely. Policy uncertainty, previous speakers have covered. This is the new normal. So what's this really about? I think if you follow Trump, you want to follow Besant and you want to follow Stephen Mirren. Stephen Mirren wrote a paper in November last year called Restructuring the US Global Trade. It's really useful. It tells you what the thinking is, tells you where they're going. There are 2 basic pillars to the thinking. The first one is that there's a club. It's called the US dollar reserve system. And I think while there's a lot of talk and a lot of airtime being expressed on trade deficits, not a lot of folk are following and thinking about the currency side. You've got to think about both. What is the objective? Trump is putting in place a whole range of engagements to do 2 things. Change the playing field in terms of access to markets for US companies, and then deciding who remains part of this dollar reserve system. With China having expanded over many years, the system had become a little unbalanced, and so now there's a selection process and a negotiation process underway to decide who stays in the club, who benefits from US security, who benefits from US dollar reserve status, and who does fair trade. and it's as simple as that. So when you hear about bringing jobs and industries back to America, it's a little bit one-sided. That's the black line on the chart. US has become a very service-oriented country. They run massive trade surpluses with the rest of the world in terms of IT and data, but you can see where the political objective is. So why the sensitivity over China? The chart on the left, courtesy of Alpine Macro, I thought illustrated the point very nicely. China has got to where Japan was in the 1990s. Looking around the room, there are some of us in the room old enough to remember the Nikkei at 44,000. It fell dramatically. The US destroyed Japan. They can't let China get stronger. It's not in their strategic advantage. The charts on the right-hand side show that China has prepared for this. America is no longer the biggest part of their lives. It was in the past. So I'm surprised at the meeting in Zurich. And I think what happened was that China walked in and they said, would you like to reduce your trade tariffs, or would you like us to devalue the yuan? You choose. And I think it was a fairly short conversation over a weekend. So where do we go to with this Mar-a-Lago Accord? It's complex. Mirren, in his own paper, indicates that he has no idea how this would work. But I think the picture that I'm starting to see is if you're invited to and you join the club, you get benefits. Preferential treatment, preferential trade deals, capital flows. Look who's gone to Saudi Arabia, Jensen Huang, AMD, all the folk, Tesla, people that Trump wants to open up the markets for. And I think what we'll start to see, and Besant has indicated that he would like to be part of an engineered post-Bretton Woods system. In other words, if you're part of the reserve currency system, you're part of the club. He refers to it as the green room, the yellow room, and the red room. What we do within ThinkCell in terms of trying to understand where we are is we construct this map. It's a very simple map. Top left-hand side, stimulus, bottom left-hand side, you're in a growth category, you contract and you go into recession. I think all the talk of recession is a little bit premature, and what we've really seen is a volatility shock, where we've moved from a position of high growth into a position of uncertainty driven by volatility. The importance for us of this chart is that it significantly influences our choice of sectors and companies within each of the quadrants, because the vectors that drive, or the factors that drive earnings growth, are quite significantly different for each. Where do we think inflation's going? We don't see a massive shock, but we do acknowledge that over the short term the pressures have increased. We're watching the bond market quite carefully to see if there's any additional funding risk at the long end. The guys that were on the fixed income panel this morning spoke very eloquently and in great detail around how the US could be in a funding risk position, and that term premium that sits at the long end of the inflation curve could be persistent for some time. So I like a little quote from Jerome Powell the other day. He said of Trump, he said, I don't think they need my advice as much as I need their advice on monetary policy. And that's quite a slap from a Reserve Bank governor. So let's see how that movie plays out. I don't want to scare you with this chart. I just wanted to use it as a framing device. I have had the privilege of being in the market since the 1987 crash. I've lived through about 9 of these things. And bear markets, it's a question I often get asked, is this a bear market? No, this is not a bear market. This was a repricing of a risk-driven event. Bear markets happen in 3 phases. The first phase is there's a shock. Something breaks. Mostly it's a liquidity, currency, or interest rate-driven event. And then what happens, economies have to adjust. And you go into the second phase, which is where the big drawdown happens over a much longer period of time. And that's normally because economies contract, companies reduce earnings, and you have a massive downdraft in earnings which pulls the markets down. And you can see that in this table over here, where I know there's a lot of data, but just focus on the top line. If you have a small risk reset, the price adjustment in the market is quite low. If you start to get a real downdraft in earnings, that's where the real damage is done. The thing that bothered us in December last year and why we started to take a lot of risk off the table in global macro was that you got no additional compensation for the risk that you were taking in equities. So this is a really long-term chart. I'm not sure how relevant it is, but it paints an interesting picture. It goes back to 1880, and it talks about how you are rewarded for taking risk in equities. And you can see in previous cycles where we've had big market declines, equity risk premiums shoot up as high as 20%. In December last year, they were 0. You got no additional benefit in terms of risk premium for being invested in equities than you did in US bonds, and that wasn't going to sustain itself. So last slide. The slide was constructed in early January. It's not a slide that was constructed in preparation for the presentation. And effectively what it did was it said, okay, if we wrap this all together, what's changed? I think quite a lot has changed. The dollar reserve status has changed. Capital flows around the world have changed. Trump has changed the security equation. He's changed the equation of what drives countries and their decisions around their currencies and interest rates. And he's also changed the playing field in a very short period of time as to what markets are more accessible or potentially more accessible and which ones are more closed. So how do you navigate within this framework? This is sort of how we see the picture. On the positive side, we started to move into much more defensive growth in the US. We continue to look for product innovators. We thought Japan and Europe would start to add a growth element to the portfolio outside of our traditional positioning in US growth stocks. We liked a hedged China position. We thought the stimulus that would come through from that side would be good. And the reason for that is you go back to Keynes. Keynes gives you a very good clue. If you're in a demand side shock, which is China, you have unemployment problems and you've got to stimulate. If you're a supply side shock, which is America, you have an inflation and a growth problem and you've got to address that. On the negative side, we saw high beta as risky because we saw volatility increasing. Cyclicals, temporary. European defensives were negative because they just lack any impetus of growth. We saw the Chinese yuan as the canary in the coal mine. Some folk might remember August the 11th, 2015. China was going to devalue their currency by as little as 3%. The market declined 10% overnight, and for reasons already mentioned, long duration nominal. So if I had to summarize it in the 20 seconds I've got left, we think that there has been a regime shift. That regime shift will affect currency markets, capital markets, and flows, and in that context, follow the flow. Thank you very much.
Thanks, Tony. Can everybody hear me? Yeah, it looks like we had a sound problem earlier. Thanks, Tony, Philip, and Faniel. I'll start with you, Faniel, in terms of your mandate that you manage the Portable Alpha Global Solution, a very cheap MSCI World Equity Tracker. People say, oh, well, it's outperformed many asset managers, so we certainly subscribe to a passive allocation and a alpha manager complement. But the MSCI World in itself, is it passive? Doesn't it rebalance from time to time? Say, for instance, the continued sell-off in terms of US assets, which obviously didn't happen in the last week, but during the year we had a move from Europe, or from US to Europe to Japan. What would happen to the index?
Okay, no, thanks, Rudolph. To answer that, we obviously chose the MSCI all-country weighted index because it's a combination of both. Obviously, the disadvantage is that it's still 70% the US beginning of the year, and the rest of the.
But it can change.
But it can change.
How often?
So for us, we change quarterly in terms of managing the funds, the beta exposure there. We're quite agile in changing our exposure there quarterly. Then obviously in terms of the enhancements to provide that kicker, that alpha, that's something that's ongoing. But in terms of changing the structure, it's a quarterly thing to react quicker to the market, yeah.
Using bonds?
We use listed futures for mark-to-market and also liquidity. Then we also use the conventional money market instruments to provide the kicker, the alpha, to the enhanced, to the beta. Yeah.
Well, that's certainly something to consider for portfolios, because it's a really cheap way of tracking the MSCI World Equity Fund.
Yeah.
The MSCI All Countries World Index, which includes emerging markets.
It includes emerging markets,
Good. Philip, moving over to you. US Treasuries has been a debate, and we hear from Tony potential dollar devaluation. We hear from other speakers liquidity risks. But you have chosen, in terms of your inflation fear, gold as your cornerstone to hedge against inflation and other reasons. Many other managers would combine gold with US dollar TIPS, inflation-linked bonds. Have you considered that? Or if you have considered it, why not?
We have considered it, but we do see, the main reason for our gold positioning was the one truly risk-free asset, which is the US Treasuries, not the TIPS, but the US Treasury. And we, from here, see a potential short-term inflation. We don't see long-term inflation concerns. And the holding of gold is less so for inflation than what it is for its risk-free status.
Okay. So, Tony, on that subject, you mentioned the bear market normally starts with a liquidity risk. And we all know that in the next 12 months, there's a lot of US Treasuries that needs to get funded. And does that pose a potential liquidity risk under the regime of this dollar devaluation club or US club that they are orchestrating via the Trump actions?
Yeah, Rudolph, just to make the point and be clear, I don't think dollar devaluation is a certainty. I think it's far from a certainty. It's a great theoretical construct around the Mirren framework. So I think we've got to watch very carefully. I do think, to the previous point on gold, its allied function is very much central bank accumulation, because what comes out of this Mar-a-Lago Accord is really to take the pressure off the US in terms of being the sole reserve currency status. China's already started to transact regionally in its own currency, and that's helpful because it takes away some of the pressure of the reserve of the US on reserve funding. So I think longer term, one's really got a very varied scenario going forward. Does the US bond refinancing produce a liquidity-driven event? No. If you go back into all the past stock market crashes, whether it's 92, 94, 98, there's an event that is unforeseen, that creates an unexpected fissure in the liquidity cycle. And I think one thing that we can take some comfort from is that central banks have become much more alive. Swap lines are much more sophisticated than they were in 2008, and central banks are much more alive to capturing the liquidity trap. One of the speakers on the fixed interest market this morning spoke about how our own SARB stepped in COVID and dropped interest rates and bought bonds. So I don't see that as a liquidity-driven event. A liquidity-driven event, when you look at the transmission mechanisms of how markets operate, it would be Trump does something that the markets do not foresee. That creates a volatility-driven event. That event in itself could lead to dislocations because market participants are not positioned for it. So you go into the Swiss meeting, he says 80% tariffs looks like about the fair price, come out with 10. Imagine you're a trader on the JP Morgan equity desk, you've got a short position on S&P futures, it gaps up 3% in a minute, good luck managing your risk on your book. that's the type of event that causes dislocation. And I think that's why Scott Bessent, who is very experienced in financial markets, has tried to dampen down some of this political rhetoric and calm the nerves, so to speak.
Thanks, Tony. In terms of emerging markets, it wasn't really mentioned in any of your presentations. I know you will have an exposure via your index in your funds. Where do you see emerging markets in the short and medium to long term attractive? Is it time to add, or do you need more clarity in terms of China? You go first, Phil.
Yeah, so when we shifted from the US in the last quarter, we moved to Japan and to Europe. And there maybe very slightly bit amount to China. Like Tony, we also look very much at the Chinese bond yields, the 10 years, and if you see how the Chinese 10-year yields had crossed over from the Japanese 10 years, which has been over 4 decades, that was quite an interesting event for us. And you know, you can also play China via Japan as well. The biggest foreign direct investor in China is Japan. So if China's doing really well, but you're not comfortable with the macro or political risk, you can be safer in playing it through Japan. We've got one SA equity stock in our portfolio, and nothing in LATAM at the moment, but we have been invested before in LATAM. So at the moment, it's very much still DM dominated.
DM.
Yeah.
Thanks, Philip.
Just to add to that, if you look at the trend that Trump has set in motion, capital flows around the world are going to change. And I think the one topic that is quite interesting, has US exceptionalism ended? It may not have ended, but it certainly is going to slow. What was US exceptionalism about? It was really about US companies being able to transfer their labor costs to China and bank the margin. Amazon's indicated that it's interested in moving to Mexico. That changes the dynamic of capital flows. So I think where we're sort of quite sinking on the views is that the capital flows and the risk-reward relationships are changing, and that will influence what companies choose to do in the future, where they choose to locate business, and how they choose to operate within this complex globalized world. Trump's not going to undo 40 years worth of globalization in 4 months, but he's given it quite a big whack.
Thanks, Tony. We've got 6 minutes left. Questions from the floor. Put your hand up. There's a roving mic.
So, my question is to Philip. Quite impressive to see your allocation in gold at 7%, which I think, in my view, it means to say a well-balanced multi-portfolio fund must always have gold, which it's been doing very well in a couple of years. Now, the question for me is that while gold is doing well, have you ever considered looking at silver, which basically sometimes performs like gold and sometimes outperforms gold with similar characteristics? Of course, that information is that it also gives you an expression into green energy like solar, EVs. What's your view on that, or your take on that, on silver?
Yeah, great question. So there has been over the long term sort of that ratio that gold over silver sort of keeps in line, and you get some of these violent whipsaw effect as silver lags and then quickly carries up to that ratio in terms of gold. Silver has the benefit as well of being actually used in solar panels, so it has that industrial use, and we know as the world goes more green that there is that sort of industrial demand for it. I think that what we have seen now, which might change that, is that this US Treasury default event, which has now put gold as the primary risk-free asset, changes things somewhat, and I don't see that until that dominant risk-free asset profile changes for gold. I don't see that ratio holding until then. It's a bit of a wanting to be the bride versus the bridesmaid my opinion on gold and silver at the moment. It's you want that primary risk-free asset.
Thanks, Philip. Any other questions? Where's Tian? Tian normally asks a question. Okay,
I've got something that maybe, if there is time, that I wanted to elaborate, just some thoughts.
Yes, absolutely. There's 4 minutes.
So
I have one more question if you run out.
Okay, so I'll try to be quick. But after this recent China tariffs, we're looking at effective tariff rate globally that the US has now put on globally. It's now sitting at about 12%. Given some negotiations, and let's say that brings it down to 10% tariffs on all countries. 2024 US imported value around the world is $3.5 trillion. You put a 10% tariff on that gives you $350 billion. 2024 US corporate income tax rate was $500 billion. So when they're talking about the tariffs subsidizing US tax cuts, it's actually quite significant. You're looking at $350 billion inflows that the US government has, assuming that imports and import values don't change, but that can go to a 70%, they're not going to do it all, but they can use up to 70% US corporate to subsidize the tax rates. If you get those tax rates down, you incentivize the American corporations to reinvest in America, to onshore a lot of their manufacturing, which is what Percent wants to do as well. And then you can really get a kicker in US GDP by doing that. So we should be hearing something about that in July 2025, and that could be a one-time kicker positive to EPS for US corporates.
Good. I'm still looking for a reason to buy US treasuries. It doesn't seem that there's any reason.
Well, maybe to add to that, and I think where the debate gets quite interesting is that it's a question of who pays the tariffs. So do US citizens pay the tariffs? And it simply is a transfer from the private balance sheet to the corporate balance sheet? Or in terms of this club and the dollar reserve system, are countries allowed to depreciate their currency to compensate for the tariff? And that's the traditional mechanism. So you slap a 10% tariff on China, it depreciates its currency by 10%. That currency depreciation effectively is the way that foreign countries pay for the tariff. Net, the cost to the American is not that much greater. So I think we've still got to cross that hurdle, because Trump wants a world where the US becomes more competitive in this sort of manufacturing arena, the so-called Mar-a-Lago, like the Plaza Accord, but you can't achieve all the objectives simultaneously. And where I think this sort of demise of the dollar is somewhat overstated is that the Mar-a-Lago Accord may in fact be about the incredible privilege of running the reserve currency of the world, where you take some heat off by allowing regionalization, but you allow select countries that have come in and been part of the club and playing by the rules to devalue their currencies ever so slightly, so that the American consumer doesn't end up paying for this tax.
Thanks for that, Tony. Bruce Williamson online has asked a question, and that was going to be one of my next 2 questions, so thanks, Bruce. He says, hi, no one has quantified the commodities / raw materials needed to maintain global growth, the shortage of technical skills, and how the additional supply of raw materials will be funded, especially as many projects are located in emerging markets. Emerging markets are the producers in any case. Who wants to venture on commodities other than gold?
You go.
Look, it is a good inflation hedge, but I suppose that's not the question that Bruce is asking. It's difficult. If you have a China slowdown, and what you're seeing by what China 10 years and 30-year bond yields are telling you is that there's no demand. And China at one point was more than 50% of almost every raw material. So if there's no China, there might be a bit of an India that takes up some of that slack. But China, and it looks like they could be in a depression if you look at those bond yields and certain other factors. So you could have a massive stimulus would be needed and be implemented on China for that to happen. As it stands now, I don't think so.
And the green energy legislation that's moving away, will it not improve pricing in terms of palladium and platinum?
Yes, I mean, so we've seen Trump really move more towards drill, baby, drill. We've seen big asset managers like BlackRock saying, they're taking that off their ESG list. So definitely swung the other way, away from green. It's not going to stop green infrastructure, but the pace of the growth has certainly slowed, I'd say.
Thanks, Philip, Tony, Faniel, everybody else. Our time has run out. Is there more questions? One more question?
Yeah, Rudolph, you saw. To your left, to your right. Can I ask you a question for Tony, please? Just on the macros, Tony, what credence do you give to the theory that Trump is happy or wants the world to kind of change into one of three areas of influence? And the second question related to that is, one reads a lot about the risk to countries if they are forced to choose between the US and China. So turning to South Africa, how big you think that risk is to us? Those two.
So the reason why I brought up the paper by the Heritage Foundation is it sets in very stark terms in 900 odd pages what the philosophy is behind re-establishing American hegemony. American hegemony has previously already been influenced globally by dollar denomination and the security pact post-Bretton Woods system in post the Second World War. So I think the second chart that I showed is a very clear indication that Trump admires strongmen, Xi, Putin, Erdogan, and he wants to be part of that club. It does lead one into a slightly sort of conspiratorial framework of who's going to grab what. Trump's going to grab Greenland. He wants Canada. He wants it for the resources. They're holding out, but they'll ultimately join the club. Putin gets half of Ukraine with its mineral resources, and China takes Taiwan. So in that world, it does become a little bit more volatile and difficult to read because geopolitical boundaries get blurred. How does South Africa play it? I find that question interesting because I think one of the hidden skill sets that President Ramaphosa has, and you've got to go back into an excellent biography by Anthony Baldwin on Ramaphosa in the early NUM days, is he has an uncanny ability to play both sides simultaneously and extract value. So if there really was a time for President Ramaphosa to shine on his core skill competency, it's now. Let's see what happens.
Thank you.
Give Ramaphosa some Siya Kolisi blood. Thanks, everybody. Thanks, panelists. And over to Eugene.
Many thanks, gentlemen, for a very good conversation. A lot of good questions that came in there as well. I wonder what SA is going to get since Trump is getting so much. Maybe we'll get to Lesotho or something. Let's see. Right, our next session on global fixed income or fixed income. We touched on some of these topics in the online webinar. We're going to continue with global fixed income as well as SA credit. Are we allowed to say that out loud still? Joining on stage now is Stefan Naidu from 91, coming to the front, Brandon Quinn from Saffron Wealth, and to moderate this session, Trevor Garvin, Head of Multi-Management at Netgroup. Gents, can you come to the front, please? Fantastic. Thank you. While they're coming to the front, the lights up here is quite blinding. I think next time for roaming mics, we need to get those little flashy lights so that people can see where the mics are because you can't see anything. Right. Stefan, you're going to be up first and then...
I'm going to just quickly do the intro.
Happy.
Thanks. Good afternoon, good morning, everybody. My name is Trevor Garvin. I run the multi-manager at Netgroup Investments, and thanks to BCI for having me and inviting me to chair the panel. today's panel, and I'm fully aware and sensitive that I think yesterday you guys had fixed income and about an hour ago you had fixed income, but having seen these guys' slides, I think they have got a few interesting points and new ideas and issues to debate on the topic. And we are going to be looking at credit as well as government type of fixed income instruments as well. Just to briefly set the scene, I just checked half an hour ago, the Rand is trading at 18.22, so it's actually strengthened a bit since yesterday. And just to put performance into context, over the last year, if we look at global fixed income, in US dollars, global bonds, the Bloomberg Global Bond Index is up around about 5.5% in dollars. US government bonds are up also around 5.5%. Investment grade bonds or corporate bonds are up 4.5%, and high yield or junk bonds are up 9% in US dollar terms. Equities are up, global equities are up about 14%. So just to put a bit of context into what the returns have been over the last 12 months, South African bonds, as you've heard, have really been unbelievable as an asset class the last 12 months. Returns of about 19% for South African bonds over the last year, which I think is about a 1 in 20 year event to get returns like that. So fixed income is certainly an interesting space at the moment. So that's really just to set the scene. We're going to have the similar format. The two guys will each present for about 10, 12 minutes, each of their slides, and then we'll open it up for some discussion and debate. So first up is Stephen, who is a portfolio manager and credit analyst at 91. He holds a business science degree from UCT and is a CFA charter holder, and many years of experience. He's been at 91 for approximately 10 years or so. So Stephen, I hand over to you.
Great. Good afternoon, everyone. It's a pleasure to join you all here today at the BCI Global Investor Conference. I'll be sharing 91's views for the case for South African credit and why it matters, why now, and how we think about credit in a portfolio context. So maybe just to start with the why. I guess off the bat, net yields are very attractive. 8 to 9% if you're in a cash duration product, 11 to 12% for an ORBI linked duration. Credit really provides investors with strong protections. You know, compared to other asset classes, debt investors are higher up in the capital structure, sitting ahead of equity holders, which means that you have a moat of protection to cross before credit investors had to take pain. The other big positive of credit investments is that you have enforceable legal rights, which means that there's an opportunity to recover value even when things go wrong. Credit instruments also have predictable cash flows and low historical default rates. If we look at Moody's default study from 1983 to 2024, you can see that in the global rating scale of BB, which is where most South African investment-grade credits lie, the probability of default is about 70 basis points, with a loss given default of about 60 basis points. To put that into context, that's less than a month's return on an average fund. So there's a proper income shield that protects investors, which really makes it ideal for conservative investors seeking capital stability and cash-beating returns. Additionally, I think in an uncertain environment such as the one we're in, credit allows investors to stay on the liquid side of the market in a lower risk asset class waiting to deploy, which really makes it a strong case for both a defensive positioning, but also a means to enhance yield above cash. Maybe with a little bit of a background on the market context and zooming out a little bit, let's think about how credit looks in South Africa. You can see the chart there on the top left-hand side, which is issuance volumes through time. And pre-COVID, really, the market was running pretty quickly. The market was growing. We had COVID, and issuance fell off. Since then, we've been growing slightly, but on a net basis, the market's actually been shrinking. So from a supply perspective, it's been very constrained, and the mix has changed. Banks haven't really had balance sheet growth. Corporates haven't really been leveraging. There hasn't been capex. And the SOEs has been on the naughty step. So with that supply backdrop, if we think about the demand side, the chart on the bottom left looks at collective investment scheme accounts in South Africa, and you can see those purple bars there. That's the amount of fixed income portfolios which has been relatively static through time, and there's been a strong bid from the institutional market for credit assets. In addition to that, as I mentioned, bank balance sheets haven't really been growing, and banks haven't been quite aggressive on credit risk appetite. So we've seen banks looking to invest more and more into high-quality liquid assets, also bidding for credit. This has resulted in strong demand in the face of constrained supply, really driving credit spreads tighter and tighter. So you can see the chart in the bottom right there, which looks at the long-term standard deviation of credit spreads around the mean, and you can see that we're well below the 1 standard deviation point now. So with that market context, is credit still attractive? Well, let's start with cash rates alone. You can see the chart there on the left. We've had persistent rate increases while inflation has actually been falling. Just by being in a cash benchmark strategy alone, you're able to achieve 5% of real returns. If you add to that the benefit of credit, it can significantly enhance yields depending on the duration of the strategy, as I mentioned. So net of fees in a cash neutral strategy or cash duration neutral strategy or an Orbi-linked strategy, you're looking at returns between net of fees between 9 and 12%, which is pretty compelling locally if you think about where the South African government bond is right now. 10-year government bonds, probably about 10.5%. And even within a global context, if we look at where emerging market credit is in that double B bucket, it's currently offering a yield of about 6.5%. So we think that SA credit remains competitive both in a local and global market context. The question then is, well, why now? Well, maybe let's do a little bit of a stock count on the positives, the neutrals, and the negatives. On the positive side, load shedding is stabilized. Finally, that thorn in all our sides has been dissipated, which has been the main economic detractor for South Africa for many years. We successfully negotiated a peaceful power transfer through the GNU, although not without speed bumps along the way. Tourist arrivals are up. We're seeing infrastructure investment. We take Sanrail, for example, with roughly about 50 billion planned, creating about 35,000 new jobs. Rate cuts have finally come through with inflation starting to moderate. On the middle ground, though, we've had a very delayed but pragmatic budget set to be delivered later this month. Still some uncertainty around that. Transnet, yes, there's been short-term benefits in unlocking some of the port congestion, but we're a far way away from operating at peak capacity. NHI, we know it's coming. We don't know what form it's going to be, or how it's going to be implemented, or how it's going to impact the fiscus. We just know it's coming. And then on the downside, the risks that we're watching. Geopolitics, I think most of the speakers have mentioned that today. Tariffs, they're here, they're gone. Okay, maybe they're back, but partially. We don't really know what the scene looks like. We've had the Russia-Ukraine conflict. We've had India-Pakistan. We've had the Middle East. There's mass uncertainty really hanging over the outlook for global growth. So in short, while there are green shoots, the local and global economic environment really supports the need for defensive posture, which is exactly what credit delivers. Well, credit is not without risk, and I guess it's important to understand what the drivers of these risks are so that we can best navigate it. What did we learn from the last crisis? Well, if we look to COVID, we saw spreads widening as the market searched for liquidity in the face of uncertainty. While spread widening was across the board, it was most pronounced in the most liquid segments of the market, in particular financials. And within the financial sector, we saw high-yielding instruments, alternative Tier 1 and Tier 2, impacted the most, as the market sought to move paper as quickly as possible. AT1 instruments were high demand pre-COVID, and still are, and the market sought to tap into these pools of demand. There is also the element of uncertainty. Capital instruments do carry higher loss given defaults, and one could take the view that the market was looking to cut risk as quickly as possible. So what do we see? Well, if you look at the chart on the left-hand side there, in the secondary market, we saw spreads push out pretty quickly. Each dot here represents a timing point in which the mark-to-market on an AT1 instrument across issuers changed. And you can see in 2020, spreads blew out by as much as 200 basis points. But just as quickly on the right-hand side, you can see how quickly spreads retraced, supporting the thesis that demand for credit assets are sticky when it's driven by fundamentals. SA banks proved very resilient through COVID, strong balance sheets, good provisioning, good sound internal capital generation. While businesses that had risk factors such as liquidity risk, poor cash flow, high gearing weren't spared, and there were plenty casualties through COVID. And I think we've seen some of that latent risk manifest now in the structured credit market with the likes of Enable Capital, Bridge Taxi. Credit risk being masked in these structures as the market searches for yield by going down the credit risk curve really doesn't lead to good outcomes in volatile markets, which in our view really supports the case for sound bottom-up selection, which was invaluable then during COVID and will prove invaluable in the future. So how do we actually build and manage a credit portfolio? My equity colleagues love to jab that we can just sit back and clip coupons. But in reality, we're not passengers. There's many levers to pull on. Credit risk is probably the biggest lever, which we've just discussed. And it's quite easy to dial the risk curve up to get credit returns pretty quickly, but you can also get carried out pretty quickly if you get the call wrong. One could add credit returns by extending term, but there's other considerations. A 7-year corporate view is very different to a 3-year corporate view. Business cycles change, there's competitive pressure, there's market dynamics. There's also credit spread duration, which means that the price is much more sensitive the longer on the curve you go to credit spread changes. There's duration risk, which we're all familiar with. There's offshore exposure, accessing mispriced risk. But how creative do you get? Do you buy a basket of an indice? We've seen what happened in the Chinese real estate sector with that basket having names falling out of the indices, impacting local investors here who had no clue that they were exposed to Chinese real estate risk. There's also the opportunity to diversify the portfolio, more concentrated, more sectors, take a bigger view. And lastly, there's structured credit, which really has been on the rise. But what's really in the box? What's underneath these structured CLNs? What's in these SPVs? So with all these levers at hand, how do we think about credit at 91? Well, for us, we're looking to back sectors with strong fundamentals. The financial sector has seen a real flight to quality, leading to spread compression, and this has been a big thesis for us. Infrastructure is a strong theme as well. You're looking to back quasi-monopolistic entities that really provide essential services to all South Africans. Take the ports, there's only one way to get in and out of the country. Key infrastructure like road, rail, and airports. And then lastly, blue chip corporates. Resilience under stress. We're looking for strong balance sheets with stable cash flows, which really are the anchor tenant within the portfolio. And for us, I think in summary, is in uncertain times, quality isn't just a preference, it's really a necessity. We believe that with a conservative approach, credit offers the opportunity to enhance yields above cash, but also in a low volatility way. Thank you.
Stephen, stay there. Just to mix it up a bit, I'm going to ask you a question straight away, and then we'll hand over. So we know the finance minister is having his third stab at the budget in the next 10 days or so. Could you just talk a little bit about perhaps the budget and the aspects of the budget that maybe affect the credit market and how you manage a credit fund, etc., and what are the things you're looking for in the budget in terms of your credit positioning and fund positioning?
Yeah, I think, given it's Budget 3.0 now, we're all quite well versed with all the iterations. And I think for us, our view is that it was pragmatic and an outcome in which it was recognized that fiscal restraint is necessary if you want to increase expenditure. So we were looking for signs that the GNU is able to work together and raise issues vocally and also concede, because that's a sign of a good democracy. I think the credit market didn't so much react to the budget as it did react to overall global volatility. I think most recently we've seen global volatility peak, and amidst that we actually saw several primary auctions in the credit space being pulled back. That's issuers not feeling comfortable that their paper would place both in volume and at price. I think we've since seen that retrace. A couple of private placements have shown that there is still strength, there is still an institutional bid for credit, albeit spreads have pushed out somewhat. So I think what we're looking for from the budget is really any sign that the government is looking towards pushing the economy into a growth vector and to reduce the volatility and uncertainty in not just the credit asset class, but markets in general.
Great. Stephen, thank you.
Thank you.
So guys, next up, we've got Brandon Quinn from Saffron Wealth. So Brandon is both CEO and a fund manager at Saffron Wealth for many years now. He's been managing long-only and hedge funds for the past 20 years or so in terms of the fixed income space. Also as a BCom and a CFA charter holder. And Brandon, yeah, excited to see what you've got to say. You certainly had some interesting slides there. So I'm handing over to you.
Yeah. Thank you, Trevor. Firstly, thank you everyone for attending, and particular thanks to BCI for always putting on a first-class conference. It's always a pleasure to be here. All right, and thank you for the introduction. We are Saffron Wealth. We've been around for about 12 years, going on 13. So hopefully the survivorship bias aspect that many of the previous speakers brought up is slowly but surely playing into our favor. We manage quite a few funds across various asset classes, most of which, though, have a fixed income core that we use to amplify the returns in the various asset classes. You all know our Opportunity Income Fund in the low risk quadrant. You all know our Active Bond Fund, which we consider to be in the medium risk quadrant. You know our Global Opportunity Income Fund, and that's really the basis that I'm going to make a presentation from today and answer questions on in relation to the global fixed income market. We've got our Qualified Hedge Fund and, of course, our Saffron Flexible Fund, which is in the equity space. Okay, in terms of performance, this is our bit of corporate PR. What do we specialize in? We specialize in delivering high-quality returns. Quality in our world is defined as delivering a comparable, if not superior, gross return at lower volatility. If you look at the charts on my right and left, you'll see that our Opportunity Income and our Active Bond delivers, and these are, of course, after fee returns that are compelling as well as exhibiting lower volatility. I don't think the laser works, no, just checking. Yes. Okay, if we look at the global space, there's our global fund. Our Global Opportunity or Enhanced Income Fund seeks to deliver about a 3% margin on top of prevailing US cash rates. So credit, in the context of Stephen's discussion, is very important to us. But we really are also a macro house. So we specialize in positioning for duration and across currencies as well. Okay, so what I thought of doing today was really updating a presentation that we made at a previous global conference some time back. And one of the key questions then, and of course it's reared its head again, is, are we facing a recession? And what we thought of doing is just revisiting some of the key measures and metrics of how do we determine whether or not we are going to face a recession. This, of course, is the SARM rule. And, of course, you can see here that really there's nothing to worry about at this point in time. And please bear in mind that this presentation was made or compiled about 3 weeks ago. So a lot has changed in the past 3 weeks. Some of it supports some of our slides, some of it doesn't. But to the large extent it does. So from a SARM rule point of view, we really don't have anything to worry about. And that is in stark contrast to a lot of the news flow we're seeing, a lot of the sentiment drivers we're seeing, and certainly a lot of the fear that is facing the market, and that resulted in the sell-off that we all experienced over the last three, call it the last month. Here, I need to make this a little bit larger. Here, for example, is the New York Fed recession indicator. And this really just compares the 2-year points on the US curve versus the 10-year point. Recessionary conditions tend to push down the US 10-year whilst lifting the 2-year. And that we're not seeing. We did see it tick up slightly from about call it a 15-20% probability of recession, all the way up to 30. But in the bigger scheme of things, these are small moves. So there was a lot of market panic, but really it isn't supported by evidence. And at Saffron, we are evidence-based investors. So really, we don't see the evidence of a recession at this point. If we're looking at forecasts, consensus forecasts, we saw the US consensus forecast for this year dropping from 2.5 to 2, but it's still positive. So yes, it's lower, it's not as great, but is there a recession on the cards? Certainly not. Now, this was an analysis that I was referring to earlier that we presented at previous conferences. And basically what we did was we took the performance of various asset classes and we measured their performance from the first rate cut for the next 360 days. This particular analysis shows the US 10-year. And if you look back on the chart to minus 60, in other words, to the far left, you can see what the performance has been over the last 360 days. And there's pretty good performance coming out of this thing, almost 10% worth of performance. If we look at the performance of the US 10-year since the first rate cut, it's really been lackluster. And you will see that in many of our peer groups who are strategically longer duration, that performance has, of course, waned. In the case of our global income fund, we have what you would call a large barbell position, which is we're very, very heavy, the short-dated US Treasuries. So in truth, higher inflation expectations in the short end actually serve to keep our running yield quite high, whilst at the same time we're tactically positioned in the US 10-year. US high yield. I love the phrase junk bonds. Dates back to the 1980s, and from time to time, they certainly are junk. And we saw that massive sell-off after the tariff tantrums. What's interesting there, and it really amplifies Stephen's message earlier, which is the fact that there's limited supply, particularly in this market. We saw the rapid recovery of that US high yield market. If you look at this chart, you will see the performance is the light black line. You will see how it dipped. And when we compiled this presentation, there was the likelihood that given a non-recessionary condition, which is the blue line, we would see a rebound in that US high yield market. And in fact, US high yield markets over the last month or so have really performed exceptionally well and have gravitated towards a non-recessionary outcome. So just bearing in mind the blue line is a non-recessionary outcome since each rate cut historically. So we've looked at every single rate cut and how the asset classes performed after that, and we worked out what is the average performance since that point in time. So US high yield has actually done quite well and is gravitating more towards a non-recessionary condition rather than a recessionary condition. If we look at the Albi, now the Albi has been exceptionally interesting. Earlier on, it was mentioned a 1 in 20-year event. Well, that's exactly what it delivered. Just north of 20%. Over a 360-day period. What's interesting too is that the very recent rally, and we'll be the first to say this, the very recent rally we thought was over-exuberance in the GNU, so as active managers we downweighted our Albi exposure, and into the recent volatility we've largely upweighted our exposure there. So you can see that, and you'll see that in the performance of our funds. Our active bond fund is now sitting at about 1.6, 1.7% of ahead of the Albi on a year-to-date basis. In a non-recessionary condition, the Albi has delivered around 9% if we look at historical returns, and at around 5% in a recessionary condition. And why is that? It's because of the large coupon-bearing characteristics of the Albi. Stephen also mentioned the fact that credit provides protection, and that's exactly what it's doing there. The high coupon rate provides a higher level of cash flows, and those serve to dampen the effects of market volatility. CRB metals. Now, in the previous presentations, CRB metals, industrial metals, precious metals were highlighted. What's interesting is that historically, the CRB metals index in a non-recessionary condition after the first rate cut over a one-year period produced minus 4%. And in a recessionary condition after the first rate cut produced minus 15%. So this is a very tricky asset class. If you look at the historical returns, you can see the black line lifted all the way up to 10%. And that was largely as a result of the Chinese stimulus that was introduced by the Chinese central bank. Now, the reason why it didn't sustain is exactly why we all think, which is the fact that the Chinese stimulus was nowhere near large enough, as large as it was nowhere near enough to really underpin demand in China. And as a result of that, the index exhibited or retraced back to its previous lackluster levels. Looking at the US 10-year in terms of our modeling, and bearing in mind Saffron is a quants house, so we evidence-based. We like to model where we think is fair value. You can see that at the point at which we compiled this presentation, there was about 40 basis points worth of upside still in the US 10-year. So yes, we don't necessarily believe it's a full 40, but what it does demonstrate is that there is still potential gain to be made out of the US 10-year. What it also emphasizes is the fact that the opportunities presented to active managers are far different to the opportunities presented to index tracking funds and passive funds. What it means is that we are able to capture these kind of movements without taking the loss going into it. So, we were underweight and have reaccumulated some of our US Treasuries in our global fund. The last number that I looked at was around 6%. So we long about 6% in our global fund in the US Treasury side, US 10-year, but at the same time harvesting that higher yield out of the short-dated US Treasuries. If we look at South African bonds, there are definite opportunities exhibited over the recent past. One of them, of course, was the budget event, as well as the taper tantrums, and we used that to upweight bonds into our global bond into our local bond fund. In our local bond fund, we thought that the GNU was overpriced. In other words, the benefits of the GNU were overpriced and there was too much market exuberance. We shortened our duration and have recently picked that up again. Resulting in outperformance. So if we're thinking about, firstly, is there a recession or isn't there a recession? And there are arguments to be made for both ways. But if you believe there is a recession, you should be buying the US 10-year. We don't believe there is a recession on the cards, but that there are tactical market opportunities to position in that US 10-year, particularly in our offshore funds. If we're thinking about, sorry, my eyesight. Oh, I have glasses somewhere. If we're thinking about US high-yield debt, the no recession should result in a fairly substantial pickup there. And to a large extent, we've seen that already. That 8%, we've seen a solid 5 of that coming through already. In terms of the all bond index, a no recession event is very promising for a solid 9% return. If we look at our South African active bond fund, the Saffron active bond fund, that's sitting now at a gross yield of about 12.2%. So assuming no market volatility and capital stability, that should yield approximately 12.2%. So that's a very attractive yield. If we're thinking again about asset allocation, and to the extent that equities start to become overvalued, we would see this as a good opportunity to be rotating surplus profits out of your equity positions, certainly into the likes of an active bond fund or a bond fund that's yielding about 12.2%. And that's us. Thank you.
Great. Thanks, Brandon. Just one question while you're up there, and then we'll see if there are any questions in the audience. Can you just talk, we're focusing a bit on global from your side.
Yeah.
just with the central banks and their interest rate policies. I mean, we've seen the Bank of England and ECB recently lower their rates, interest rates. The US, Jerome Powell's kept it the same. How do you just see these things playing out, and in a way, how is that influencing some of your global bond decisions?
Yes, I think you know the important thing to bear in mind is that the central banks control explicitly the short end of the curve. So the short end of the curve is a big determinant of growth. It's also reactive to inflation conditions, whereas the further out along the curve, the less control they have, except through what you'd call open market operations. Now, in the US in particular, they've been manipulating the long end quite significantly over the past. They've made their issuances, they've pushed supply into the market in the short-dated Treasury side, and that's also informed us as to why to hold on to those short-dated US Treasuries, because from a supply point of view, they continue to offer you value. But at the same time, by constraining the supply in the 10-year area, they've kept those rates lower than they perhaps should have been. But at the same time, what it does is it improves the cost of capital for long-term projects and whatnot. So to the extent that the short end of the curve is determined by central bank policy and inflation rates, that really plays into our carry argument. How much short-dated yield do we want to keep in the fund? Typically, within the credit space, just to tie it back into the credit world, typically we enjoy credit in the 2 to 4 year area. We're not long-term credit players. We don't like credit duration. We believe also that financial statements and other information allows us to look fairly clearly 1, 2, 3 years ahead. Beyond that, it's the opacity of the information becomes questionable. So typically, we play in the 2 to 4 year area. If you look at credit curves as well, the steepest part of a credit curve is there. So from a bang for your buck point of view, the best value is to be harvested from that 2 to 4 year area.
Great, Brendan, thank you. Stephen, a quick question for you, and then, guys, if you've got any questions for the panel, please get ready. I think talking about credit, one's got to focus or highlight, I guess, the risks, one of the risks, which is default risk. And if I think over the last 10 years or so, I mean, we've certainly had some examples of corporates going bust in South Africa, Steinhoff, African Bank, SAA, Eskom to a degree, etc. So, I mean, we've certainly felt the pain some of the time. Can you just talk a little bit about what default rates are, how do you manage against that, and just your experiences on that?
Yeah, sure. I think, I mentioned some of that Moody's data, but if we look at SA default data, Steinhoff, while it did default, there were actually no losses to credit investors here in SA. And that really goes down to where you play in the cap structure. So, if you're able to take belts and braces and take guarantors from offshore entities, which I think really talks to, credit, the devil is in the detail. You really need to understand the legal frameworks, understand the fundamentals on what you're entering into day one, because you're going to be in it till maturity. And then I think, the best protection against defaults in a portfolio is really diversification. We operate on a very strict limit position sizing framework, which is guided by credit ratings and LGDs, and depending on where you are in the cap structure. So by protecting yourself and limiting your exposure, you're able to limit the downside. And then the last defense is what I spoke to on the power of income. So we think about the portfolio in cash break-even terms. So how far can spreads widen before an investor would break even to cash? And that really goes to the point on where you want to play on the curve. You don't want to be too far long out, but you also want income to protect you.
Great, thank you. Sure. Have we got any questions from the audience?
Yeah, listen.
Over there. Cool.
Perhaps more for Brandon, but perhaps both of you. In terms of, would you buy South African dollar-based debt, so issued by government, if the yield is sufficient? Because when we look at it, theoretically, South African is a junk bond by global standards, South African bonds. So in that mindset, would you buy South African bonds in your fund, dollar-based or rand? And if so, at what level?
No, that's actually one of the areas that we particularly focus on, which is common sizing cross-currency type positions. A typical bond one would think about there would be the SOAF 29s that we hold. In fact, I think we hold about 1.5% in that, and that's trading in the region of 624 thereabouts in dollar terms. So yes, we do hold it. Its application is very important. In a dollar fund like our global income fund, we would hold it on an unhedged basis. So we're expecting pure dollar cash flows. In our domestic funds, where there's an advantage to holding the offshore equivalent of an asset, we will hedge it back. The lack of supply in the South African market, of in particular credit, the lack of opportunities, the concentration in the South African market has been a concern for us for a very long time. If you look at the number of listed entities on the JSE, those have shrunk dramatically over 10 years. And as a consequence of that, it means that the number of listed issuers has shrunk by the same proportion. So we as a country, as a credit market in South Africa, have been concentrated within names. Over time, we've, and possibly over the last 8 years, we've been slowly but surely seeing better opportunities in the offshore space. Our domestic income fund, the Saffron Opportunity Income Fund, holds about 40% now in the offshore space. Those include South African names that we know. Stephen mentioned MTN. MTN's a great case in point. You're going to pick up a superior margin in the offshore space than you are in the SA space. Now, you can take the currency risk if you want. In the context of our local opportunity income fund, we don't like currency risk. So we hedge back those into ZAR. What's really important, though, and I think it's worth mentioning, is that is the concept of liquidity. Tony Bell mentioned liquidity events. Yeah. Now, liquidity events are actually a huge source of opportunity for us. We tend to run large cash balances for such opportunities. The other thing, of course, is that the liquidity of the underlying instruments is really important. And I'm sure, top-notch asset managers will have liquidity scores at an instrument level. So one of the focuses that we've been doing for the past 2 years is really trying to skew our funds to being highly liquid funds. What would we consider a highly liquid fund? We want to be able to liquidate at least 25-30% of the fund in one day. And that's also what we offer our investors, is a high degree of liquidity. So we don't want you all scrambling for the door when you change your mind. We recognize the fact that it's your money, and if you want your money back, we need to get it to you back quickly and efficiently. So liquidity is a big concept for us at Saffron. And it also highlights another point, which is the growth in private credit. And that's an area that I think we all need to be cautious of going forward, because private credit is going to offer you superior yields, but it's going to be on a kind of hold to maturity basis. So, and of course, very often with liquidity gates within the funds. So,
great. Brendan, thank you. Tion, thanks for asking your question. Stephen, did you want to add anything?
Yeah, the only thing I would add is, if you're comfortable with the probability of default on an issuer basis, be it self or be it a corporate issuer, you're comfortable to hold the credit risk. But the difference between the offshore markets and what Brandon alluded to and here in SA is really the liquidity drives a lot of the volatility. So, for us, it's a tactical allocation. So we've seen with this most recent spate, MTN, for example, trading at 250 for a 2026 bond, 250 over swaps versus here in SA at 130. So there's a big dislocation. You're able to tactically take advantage of it, but you do have to be able to stomach that volatility.
We've got like 2 minutes to go. Is there any other questions from the audience? Nothing? Is there one? Tia.
Question. Would you perhaps look at combining equity with your credit exposure as a hedge almost? I know Tony spoke about it in the past, using global equity as a hedge in a local bond fund or in a global bond fund actually works quite well. Is that something like commodities? You mentioned the metals index. Is there a way to hedge physical gold with your credit exposure almost as a hedge? And would that be something you look at?
Yeah, I can start. Some of our clients use our funds as an alpha port strategy, so they would run a total return swap on an equity index to get equity-like returns, and then because credit gives you that income, you can pay for the TRS plus add alpha, so that they almost use it as a funding vehicle for the equity exposure. Good.
And certainly, and I'm talking specifically about our global fund, which is an Irish UCITS, so it has different regulations to our South African Cisco-regulated funds. We do have a 10% equity allocation, but that's not for strategic equity holding. It's literally to be able to shorten equity to protect a credit, and that would be to your point. Yeah.
Great. Guys, Brandon, Stephen, thank you. We are out of time. And we will just have one last question.
Just a technical question. When you hedge it back, when you hedge out the currency risk, what do you do? Listed futures, forwards, options?
Yes. In the interest of liquidity again, and of course transaction costs, we use listed futures. We can use longer dated forward exchange contracts, but listed futures are very, very efficient. They also are very transparent with regard to the embedded interest rate costs, and to the extent that we are importing risk from offshore, in other words, buying dollar assets for local funds, they serve to be additive. If you remember your interest rate parity theories, if I was a US investor hedging ZAR risk, I effectively pay the interest rate differential. If I'm a South African investor hedging offshore assets to domestic ZAR, I'm effectively receiving the interest rate differential. So it's additive, which to Stephen's point about MTN, even adds to the economics of those kind of trades.
So to finish off in 5 seconds, each of you, tying it into the previous fixed income presentations, if you take fixed income credit as an asset class and you're managing a multi-asset portfolio, would you guys, as fixed income experts, be overweight, neutral, or underweight as an asset class? Stephen?
Well, I can speak of my own balance sheet. I was overweight, and I've cut back and I've moved more neutral now. So I think you want to have an allocation in it to earn the income, but you also want to have liquidity available to deploy into this risk market.
Yeah, I would agree with that. In terms of the all bond index, we're more or less neutral. We think that the running yield is very attractive at these levels for the amount of capital volatility the one is taking on. And then in the offshore space, I think tactical opportunities are going to be the order of the day going forward, especially if one's trying to improve your Sharpe ratio in the funds. You need to be able to enter into value and exit fairly rapidly once your view has been realized.
Guys, thank you very much. Safe travels back to Cape Town for all three of us, I think. And thanks, everybody. And I think there's one more session to go.
Thank you.
Cheers.
Thank you.
Thank you, Trevor, for running that session for us, Brandon and Stephen. Much appreciated. I could only see Brandon's papers or written papers. He actually got bonus marks for comprehensive answering. Thank you, Brandon. Right, our next session is on domestic equity. We're not going to have it in a panel format, so we've got 4 presenters standing between you and lunch. I know how it works by now. But after each presenter, we are going to allow for questions. I'm going to check the online Q&A box as well. But from the floor, as they present, you're more than welcome to post your questions. We've got the roaming mics at the ready. Up first is Cy Jacobs from 361 Asset Management. Cy, thank you so much for joining us here this afternoon. It was great to have you with us.
Right, good afternoon, everybody. I guess we are the graveyard shift today, it sounds like. I didn't realize that this was the last session. I've also changed the whole format of it. We're not going to be sitting afterwards, so please, I want some questions after the short presentation. And really all I'm here to do is just talk about SA equity, obviously, and some of the key themes that are influencing our thinking at the moment. Just to touch off on 361, and I'm sure you've all familiar with 361 by now. We have had pretty good track record across all our mandates. You know, our mandates include obviously hedge funds, this SA equity fund, we do balance funds, long only, offshore, everything. So we are a multi-diversified asset management firm. We style agnostic, so we very much try and understand the globe and the macro and understand what sectors to be over and under invested in. I think for us that's important. We bring this hedge fund thinking, we hope, to all our mandates. And we think we've got a bit of a greater opportunity set than maybe some of our large competitors, just because of this, you know, basically the size of the SA market is shrinking, and we still like to move around and change our minds almost daily. So just bear in mind as well, this presentation was asked for about a month ago. I'm sure you've heard that, so already our thinking on some stuff has changed. So what we think about this year, this hasn't changed, is that we had a bull market for many years. We hardly ever have any bear markets these days, but thanks to Mr. Trump, we're definitely in a kangaroo market for now. So, you know, it's an unknown market, and it's an unknown global policy world, and it changes. And nobody's going to know what's going to happen next, to be honest. So very much it's about rotating into safety when you think valuations are high, and trying to just, in case SA equity, just trying to obviously do what we do best, is beat the actual index, because that's what we're paid to do. In our other mandates, obviously, very much try and protect capital, but not obviously in SA equity. It's really a benchmark cognizant mandate. So it's obviously shaping up, as I said, to be a kangaroo or a volatile year. You know, there are many, many red flags out there. We're in two wars. There was almost a third one that was looking like it was starting between India and Pakistan. We've got potential rate cuts globally. We've got these tariffs that are in, out, back in, over then still in now for 90 days at 30% and 10% and all various exclusions and inclusions. It's messy. So what this all can lead to, in our view, is definitely can lead to higher inflation. And I heard from a lot of the bond guys here, they're almost changing their views a little bit around duration. You know, we kind of feel the same. So a bit nervous that rates could tick up offshore. But in SA, luckily, we are in the exact opposite position. Inflation's come right down. We've seen a drop in commodity prices and inputs, etc. The rand's pretty strong, and our rates are just really too high at the moment. What's happened in SA year to date? Obviously, this again was taken a few weeks ago, but everything was about gold. Capswix basically just had gold, a little bit of platinum, one or two other shares, and basically that's what, you know, everyone thinks, wow, the market's done, you know, 9% or whatever it was. Year to date, fantastic. How come some of these managers have done nothing or even lost money? Well, it's because they weren't benchmark cognizant. So luckily, we took a view many, many years ago that our SA equity was going to be benchmark cognizant. That means that gold, which rose from some 3% in the index to touching 16% in April, had you had nothing over the last few years, you've really done pretty poorly, you know, against competitors who are benchmark cognizant. So for us, that's been a strategy, at least for the last 7 years in this SA equity, and that's allowed us to deliver a very consistent return versus the benchmark. I know there are a lot of managers who don't hold any gold, and obviously that's been a very painful trade. Luckily, in the last few weeks, we actually have been going slightly underweight, and I think now with the tariffs being slightly rescinded and potentially near some of the end of the wars, hopefully that's the right call and you don't have to be overweight going forward. I think one of the big issues for us at the moment in South Africa is obviously South African politics being particularly on the wrong side of the US and developed markets. And everyone worries about AGOA and trades with the US, for example, which is not actually a great percentage of our GDP, and we can actually survive quite fine without it. And there are alternative markets We've spoken to a lot of exporters, and a lot of them are starting to look at different markets. But the bigger issue is the actual South African investment landscape and the amount of money that US institutions particularly have in our SA bonds and our equities. There are large, big asset managers who trade here regularly, and if there were any type of sanction to happen, that would be detrimental to SA. We have seen in the last couple of weeks some interesting negotiations and the right rhetoric even from Ramaphosa, so hopefully they don't alienate the West and align themselves too much to the East, because it would be detrimental to South Africa. Back to South Africa, I think for us there's like 4 key things that need to happen for SA to really get going. The one we're hoping for comes out on the 21st of May, which is only a few days away, which is the revised budget. We need proper reforms. Those of you who saw the letter from the DA in the GNU to all its various partners, including the ANC, will see there was a very well-formulated policy stance, done a lot by private business with input from serious people, and that's actually what was required. It wasn't a DA initiative, it was actually a country initiative, and unfortunately 1 or 2 parties, we won't get into that, jumped the wrong side and killed that framework. We're hoping that comes back. We're not sure to what extent that comes back, but if that does, we likely are going to see some good reforms, and it is good for South Africa. Global macro, well, the tariff was bad, but now maybe it's not as bad, so I think it's looking a little bit better than it was a few weeks ago. We're still not seeing capital flows into South Africa, and that very much depends on the reforms. And if we see proper reforms and actionable reforms where we actually see the things taking place, not wording, I think that might help us. And the 4th thing, which has been the biggest drag on getting any growth going as well, is just the SARB being way behind in cutting interest rates when inflation has fallen to the extent it has. And I think from us, the reason is I think the SARB uses a lot of stale data. And we heard from someone pretty close, they've got oil in, for example, in their models at $85. Meantime, here's oil trading below $60. So I think there needs to be some kind of wake up there. I think we are going to get a rate cut at the next SARB meeting, but hopefully we're going to see some more. Very important. Obviously, this GNU is a big thing, and we had a fantastic year last year. Everybody was so enthusiastic about what was going on. Our SA equity funds actually positioned brilliantly. We went from net offshore long to net domestic long. It was a phenomenal year. We did 10 or 11% better than the index last year, but luckily reversed out of a lot of that in the late end of last year and bought a bit more rand hedges. We'd like to hope that now, to the 21st of May, maybe we've got a second round of that. I don't think it's going to be as powerful, but hopefully we get something started and we see a bit of a bounce back in the banks and some of the retailers together with a rate cut. So hopefully things look a bit better. Obviously, we're not doing too well on the foreign policy, land expropriation, education bills, etc. But we're hoping from this point on that we've heard all the bad news, and we see some modification of some of those going forward. Our perspective also on local markets is quite interesting. With all this politics and everything that's gone on, if you actually just track the rand against commodity peers like the Aussie dollar, etc., you find that nothing's actually happened. I mean, you can go back and look at the Aussie dollar from after COVID in 2020, and basically, even with all the stuff that's gone on, GNU, everything, we've basically landed up in the same position that we started. So it's actually very interesting. It creates a lot of noise in the beginning. See a lot of movements as a result of what happens. Even yesterday, for example, we announced load shedding, stage 2. The next thing, the rand loses a couple %, but today it comes back. So a lot of short-term shocks out of news, but actually a lot of long-term tracking is what we look at. So we try and pick those valuation gaps. And the good thing is, from a valuation point of view in the SA market, even after the run we saw last year, we've seen a lot of degradation in that, and the stuff has come back significantly. And as I said, because gold's done so well, people ignore it, but the balance of the market has fallen a lot. So there is valuation on your side, and we're quite excited about some opportunities. This is old. I'm going to leave it because putting the slides in 4 weeks ago, the whole market bounced up. It was basically showing you how bad the US did versus Europe. US has made it all up again. So how are we positioned to navigate in the market? I'm sorry, but the PE and dividend yield in this graph are reversed. So we really look for things where the PE is low, which is actually in black, and the divi yield is high in red. And when you're getting this situation, when your PE is substantially lower than your dividend yield, in a business that's growing, where your ROE is improving, and we've got a new change in management, which I think is going to look to get rid of some of these very underperforming ROE businesses, release some cash. I think there's, for once, a little bit of excitement here. We like the whole banking sector, but we like ABSA particularly from a valuation perspective. This again had to be put in a month ago, but it's been one of our biggest calls this year. The time when tariffs were introduced, we were looking for safety. So we looked at this and British American Tobacco, businesses with leverage, where leverage was coming down, PEs were low, dividend yields were high, and there's a good story. You know, we've seen volume drop off significantly. It seems to be bottoming. Obviously, with all the commodity exposure, crashing, we basically saw lower input costs and a very strong balance sheet with proper cash flow. So we like those kind of businesses in the, as this tariff news was hitting us, and that gave us an ability to perform. If you look at our over and underweights now, you can see big overweights in ABSA, like we take proper bets against the index. So Anheuser, that's five above what represents in the CAP Swix. And you look at the underweights, also big, but again, had to do this a month ago, and we change all the time. We've been buying actually MTN and Richmond at the moment. The underweights in Harmony's actually got bigger. ABSA we did take off a bit, and so it does change a little bit, and I think that's what you get when you got 361 is a pretty decent overall approach that changes significantly all the time. I think one of our big differentiators is where we've got our performance from. First of all, we don't meant to show a lot of performance, but on the left is our SA strategy versus the market. You can see every year we've beaten it significantly. Secondly, just in the resource sector alone, that is the extra amount of attribution we've managed to get against CAP Swix compared to what the resource sector has given CAP Swix. So we really think we've got a huge advantage in resources, got brilliant resource analysts and expertise there, and we've added alpha every year in that resource sector. And lastly, this is from the Alexander Forbes report against all other benchmark cognizant SA equity managers. You can see where we stack up, a much higher RR. It looks the same over 5 years actually as 3 years. Love to put the names of all those managers in the black dots there. We're not allowed to. But you can see we really do stand out, particularly in SA equity. That's it. Thank you. I see I made it exactly 10 seconds.
Fantastic.
Over.
Thank you, Si.
Pleasure.
Any questions for Si from the floor? The live audience? I don't think you see anything from the online audience. Going once, going twice. Si, very quickly from my side. We've seen your SA equity views now. Thank you very much for that. On the 361 BCI Flexible Opportunity Fund, just very quickly, on your asset allocation, if you look at the basic asset classes, SA equity, global equity, SA bonds, and you don't have to give me the precise numbers, on those three, are you underweight, overweight, neutral?
So we've become a little bit specifically as the tariff negotiation happened now. On the Flexible Opportunity Fund, a little bit less confident on long duration bonds, as you saw, actually was quite consistent with what I heard earlier. So we've actually been selling those, even including SA and global. So a little bit less comfortable on that. We'd like equity, particularly SA equity. And in the sell-off, we did buy quite a bit more global equity. So we're not scared of global equity, but a more balanced global equity across the globe than rather just US.
Right. If I have only two funds to pick from, the one is your Flexible Opportunity Fund and your Retail Hedge Fund, and I'm a 7-year plus investor, where would I allocate more to?
So you're asking me to be an advisor, which I'm not. So. And had you asked me 7 years ago which fund, I would have said definitely the hedge fund. And I would have said it even over our SA equity fund. But I think our SA equity fund's beaten everything. So how's that? So it's very difficult to know which fund over which period of time is going to do well. What I can tell you is that the risk associated with the hedge fund is the lowest in the firm.
Right.
I mean, obviously, because we try and protect all our net exposure. In the flexible fund, yes, you can move things around from bonds to equities, etc. But as you know, sometimes those are highly correlated. And as a result, both can lose you money. So that's a step up. If you're going to go into equity funds, then you're even adding the risk higher. So it's obviously, it depends on what risk tolerance you want. It's hard to know which fund is best.
So thank you. Question from the audience very briefly. Views on PGMs. I mean, these things are ridiculously cheap. And we've heard some comments earlier on, drill, baby, drill, forget about ESG, green energy. Let's just fire up petrol motors again.
So we don't think they're cheap. We think they're very expensive. We think two things. As you saw, as soon as the tariffs were rescinded, everyone thought, oh, they're going to go up, great for autos. They actually went down. Because why have they been trading up? They've been trading up because they effectively are a precious metal, like gold. So it wasn't trading, obviously, to the extent of gold, but people, I think, sought a bit of safety in PGMs. If you look at the underlying PGM businesses as such, the basket price has not improved. It's still sitting around 25,000. It was at 55,000 years ago. Costs locally have escalated. Volumes haven't improved, and the world is not using as much PGMs as they used to, and nobody is cutting supply. So our view is, from an earnings perspective, PGM companies look not so good. You had a bit of luck with like Sibanye coming right because its stake in DRD was worth so much because gold went flying. Amplats is the lowest cost producer, so it could survive if others cut, etc. So there's a few little intrinsic things which could go right for the PGMs, but overall, on an earnings basis, they don't look phenomenal, and our outlook for autos and catalytic converters specifically is not that good. So we're not a big bull in that sector.
Very, very last question from the audience, from online audience as well. Underweight on Capitec versus Absa.
Yeah, so it's a tough one. We do like Capitec a lot. Obviously, it's about valuation. And I think the big thing we never got our heads around earlier enough is that Capitec was never going to be valued like a bank. It's going to be valued like a fintech, operation, where earnings is growing at a decent rate, and it doesn't really matter what the size of the underlying book is. So books, banks normally trade at price to books. In the likes of Absa, it's probably like a 0.8. Good banks, some of the Standard and First Rand, etc., might be like 1.5, 1.7, 1.1s instead. First Rand's a bit higher because it's got other businesses. Capitec trades at like 6.5 times book. So it's a crazy valuation, but it's not about the book really. It's about the different income streams that they're able to leverage that book onto, and do it without adding infrastructure, etc. And the market's bought it. I mean, there are a couple of these global comparisons, like a new bank in South America that does something similar, got a similar valuation, and they've managed to convince the world that that's the right valuation. We're not that convinced, so for us it's still been a bit of an underweight. When it came down a lot over April, we did actually close some of the underweight, but it's still difficult to get your head around that valuation.
Simon, thank you for that. Always fantastic to have you here with us, and thank you for your time.
Thanks.
Right, our next presenter from Alan Gray, Sifisile Zana. Thank you very much for joining us here today as well. Grateful for your time, and we're going to continue on discussions on equity or domestic equity. Thank you.
Thank you. Sure. Okay, thank you for the introduction, and good afternoon to everyone. Sorry, I'm just going to stand here because I haven't changed my classes script in a few years, so I can't really see at the moment. So I named this the Looming Tales, and I think to call it that, investing is very probabilistic. We're in a, as was mentioned before, a kangaroo market. So the truth is very few people know what's going to happen. There's always some risk, and the reality is that we think about investing in a probabilistic way. There's a chance that certain things happen. We're not sure, and that probability or distribution is adjusting all the time, right? So 2024, we had the South African elections. We think the South African economy or the risks there moved from the left tail and a bit to the right. But I think the markets behaved as if it went all the way to the right tail. So everyone got a bit excited there, but we thought it went from, deteriorating to sort of status quo to reasonable. And then if I talk about the global markets, that probably went the other way, right? So, fast-growing economies great improvements out of COVID, and then whoop, go into the deteriorating side. So we think about this in a probabilistic way. We think the market sometimes underestimates the risk, and they make very big directional bets on things that are very difficult to model, actually understand in reality. And I mean, you can make lots of money doing that, right? So people made money betting on who's going to become the Pope, but how do you know? You can't do any research on that. No one really knows. And I mean, you see this here going into the election. So this is a number of months before and after the election. So you have SA Inc. shares in red and Rand hedges in blue there, right? So a remarkable new era begins in South Africa. And you see what that did to the shares and the relative price performance there. When we think about this remarkable new era, we had to pull back and say, hey, does having a GNU really mean there's a high probability that things improve significantly? And by significantly, I mean significantly enough for Mr. Price to go from 13 times earnings to 23 times earnings. Will they sell that much more clothes because of the GNU? And you pull back, you look at the numbers. So this is our GDP, or it's the real GDP gross fixed capital formation quarterly, right? So this is the actual spending that we're doing as a country on things like infrastructure, and energy. And you look at this chart, and it's a scary chart, right? So you're betting against a very difficult to change long-term chart, where even if you have very well-meaning, competent people, you still have to fund this. You still have to get the skills to be able to do this construction, right? There's a reason why a lot of construction shares in South Africa have gone bankrupt, because there's no capacity. So now you have to find the capacity, you have to find the people to build it, you have to do it right, you have to get the governance structures right and things like Eskom to be able to actually build more and get the funding from somewhere. Similar thing here. So this is targeted energy spend. So this is the Eskom run rate. 2024 is a run rate. So mostly sustaining capex, we call it. And then they want to grow, right? So you want to grow the grid effectively. So transmission expansion is the big red there, the darker red or the brighter red. And that's a difficult job to do. There's not a lot of people in South Africa who can climb up those very high poles and connect the transmission, that's needed and required, especially because we haven't been doing that for a very long time. So it takes a while to build up this capacity. And when the market gets excited about these sort of things, we pull back and say, oof, this is actually going to be a very difficult job, even if people are well-meaning and even if the CNU holds together. And you see this excitement in a chart like this. So this is the SA 20-year government bond yield from 2009 till 2024. And there's always big moments where people get excited and sentiment changes the direction there. So you had Ramaphosa in looks very weird right now, but you had Ramaphosa there first. Then that was a huge excitement. And then obviously that fell away very quickly. You had a credit rating downgrade. You had a commodity boom, which was actually very good, but it's a pity we couldn't sell all the coal and iron ore we're producing at very high prices because of transit issues. Then you have some of the sell-off. But then you have the Jafekra and GNU rally. That was last year when bonds did incredibly well, right? And Jafekra is a fancy way to say they printed money effectively. It's playing around with balance sheets and accounting to create more money, helps with the demand supply of bonds. Bonds yield improve as a result, and then people get excited about GNU. And we pull back and we say, oof, it's a long-term trend. There's a reason this is happening. The deficit is growing. We need to fund ourselves. Demand supply in the bond market matters. A lot of SA managers would have been, full weight in SA bonds. They want to get compensated higher. You get the yields carry on this direction. It matters for cost of capital, investment by companies. It matters for how much banks are willing to lend. It's this big thing that matters. So it's not obvious that the GNU changes that. I mean, this is Nenegate, a similar thing, right? So South African uproar after finance minister sacked. SA Inc. index underperformed the Rand hedges. It was a great time to buy banks, actually, in reality. So, the market gets excited or nervous very quickly, and they forget that there's probabilities to this thing, and, you can take a view, but it's very difficult to take big views without actually having real information. This is another interesting one to talk to, and it's what people are worrying about at the moment, because sometimes it's not big events. Sometimes when you look at fundamentals, there's these things that are happening slowly, and if you're playing on Excel and you drag the sheet right, if you carry on with that, the numbers start to look scary.
And people start to talk about it a long time ago. So there's a Fortune article that's a bit difficult to see by a recently retiring CEO. So Warren Buffett wrote this in 2003, so 2 years after China joined the World Trade Organization. And he said, America's growing trade deficit is selling the nation. That was in 2003. You see the chart here. So the red is annual trade balance. 2001, China joins the WTO. Obviously, the numbers increase. At the same time, you got the US debt outstanding increasing quite a bit. US becomes a customer of the world. Everyone's trading in dollars. Everyone's happy to hold dollar assets. You carry this on long term, call it selling the nation. But I think the more important thing also is the deficit. You can't carry on with this debt, and it's eating into more and more of the budget. And I think this is quite an interesting one again. So because we, the customer of the US, or the US is the customer of the world, and have a strong sort of military position, political position, economy, a lot of US assets are held by foreigners. So long-term treasuries there, it was 13% at the time of this chart, was held by foreign central banks, and 43% by foreigners overall. So they call this the kindness of strangers. Why this matters for South African equities? I guess the current view of the US changes the willingness for people to finance them, or their confidence in the dollar and the confidence in the US longer term. So our nerves was more on, not necessarily the trade deficit, but the budget deficit and the growing debt position and what that does longer term. But these things find a way to actually come through, and it took Trump to raise the issues here. If this shifts, and you've already seen it, right? The confidence out of the dollar is why gold has been so strong in the last year. It's why European assets did well, and there's been some flows into those markets because people are moving away from the US. If you sell corn to the US, you have some dollars, you're happy to put them in treasuries maybe. And if that stops, it's a big change to the markets as we know them recently. So I think this chart we used to show it, I think, 2 or 3 years ago. And I guess it was thinking about inflation. So 2022, obviously, inflation comes back. And with those are some themes, I guess you could call it, that were driving global inflation. So things like demographics, the Western world is getting older, so it's less people to work, and wage pressure was coming there. I think it was in the US, I think the car guys got a lot of increases. If you traveled in Europe around the time, every single coffee shop had a, help wanted poster outside of it. Demographics was a big thing. Decarbonization was another big thing. Everyone had to spend on changing up their grids, copper, and all those nice things. And then debt and defense is another thing. As defense is an interesting one because in effect, it's not productive spending, but the world has to do more of that spending all of a sudden, and that can be quite inflationary. But now, I think the big one that's in focus is deglobalization. For the longest time, we think that things move in one direction. As we get more educated, as we get wealthier as a world, we connect closer. But that's not obvious. And I think the big thing on globalization at this time was thinking about supply chains and how we moved away from just-in-time production and more about security of supply. But I guess tariffs has a similar impact. I'm a bit less sure about the inflationary impacts now than I would have been at the time, because for the US, it's probably going to be more inflationary. But for the rest of the world, like China has so much excess capacity of everything, and they're able to dump a lot of goods into the rest of the market at very cheap prices. I mean, if you go for a drive outside here, you'll see how many Chinese cars are on the road versus what would have been on the road 5 years ago, and the prices of those cars as well. So I think this matters for South African assets as well, things to think about, the inflationary outlook, and what does deglobalization actually mean for assets? So, when you think about something like a Naspers, what does it mean if there's deglobalization? What does it mean for commodities if there's more deglobalization? So, tricky, confusing world. And I guess the way we think about it, it's an easy thing, a bit of a cop-out though, but diversification helps you in a world where you don't really know what's going to happen. And we invest on fundamentals. So sometimes you underperform when you invest on fundamentals because you actually think about the underlying performance of the business and what they're really worth. So we try to invest like business owners rather than trading widgets from hand to hand. And sometimes when valuations are stretched, we won't own the assets, which I think is fair because if the share price falls, you've actually lost your client's money. There's no justification for that share price to be there if you don't think it's worth that. So it's a bit of a gamble. So we try to focus more on fundamentals rather than sentiment. We don't swing for the fences, we diversify. We protect the downside, and that tends to take care of the upside. So our outperformance tends to come in the down cycles more than the up cycles over the past. And then we're deliberate about where it makes sense to take risks. So there is times where these dislocations go crazy, and then 2015 Renegade, you buy the banks. It's a great time to buy the banks. And then there are opportunities in the SA markets, but I think the market often underestimates the risk. And that pretty pie chart there is just the positioning in the fund at the moment. So quite diversified. Thank you.
Right, any questions from the floor? I don't see any open questions from the online audience as well. Sife, maybe just quickly from my side. If you look at Alan Gray, we're all familiar with your roots, how you select stocks, the investment philosophy. In an SA environment where our market is shrinking, we saw a couple of slides earlier this morning, fewer shares that we can invest in. We know Alan Gray is a big company. How did that change your philosophy or how you pick stocks over the past 5 or 6 years?
Yeah, I mean, I don't think it changes much. We're very happy to take large positions in shares that are cheap and smaller. And I think also indexes are very tricky monsters, and I think to some extent they're rubbish, to be honest. You have a company as big as AB InBev being like 2% in the benchmark, but it's a massive company in reality. So you might look at the JSE market cap and think it's small, but there's a lot of massive companies that you can trade in and out of very quickly. So it hasn't changed much. I think we've actually shrunk as an overall percentage of JSE market cap, the fund. So actually, you'd say we're smaller relative to the market as we were in the past. And I think looking at indexes alone is not a realistic view of what's actually available to invest in. BHP Billiton is tiny in the market, Richemont is tiny in the market, and these are massive, massive global companies as well. And we have the 45% that also open a lot of capacity for a lot of managers.
Very briefly, other than Process, one stock that really excites you over the next 12 months?
Next 12 months. I would say it depends, but not really. So I think one that's always excited us for many, many 12 months periods is British American Tobacco. Still on a single-digit multiple, about 8% dividend yield, growing dividend yield in hard currency. And then there's volume shifts, right? So you've had like cigarettes shifting for the longest time, and all of a sudden these new generation products are growing quite well, and the economics are starting to get proved quite well in those new generation stuff. So the big one now is this oral tobacco, things that look like tea bags that you put in your mouth. It's nicotine, so there's no tobacco. It's less invasive on your actual lungs, and they're on very high margins. So it's very difficult to have as good economics as tobacco because it's like incredible economics, but these things are on very high margins because it's just a tea bag with some nicotine in it that you sell for a very high price that doesn't have the same excise tax as cigarettes, and it's way less harmful for you. And you see it in like Sweden. Like the cancer rates in Sweden are very low relative to the rest of the world because people don't smoke, they do this stuff instead. So that's one that looks very exciting at the moment. And people are starting to realize the upside there, debt's coming down, dividends are high, they're doing share buybacks. Should be a good share. And very low exposure to China, which we worry about as well.
Yeah. Very interesting indeed. Sife, thank you so much for your time and for coming through this afternoon. Always great. Thank you. Our next presenter from Anchor Capital, Mike Retzi. Mike, thank you very much for joining us. The stage is yours. Thank you.
Good afternoon, everybody. I think I might well be the one standing between you and lunch, so I'll try and be as quick and brief as I can. I am the co-fund manager responsible for the South African Equity Fund at Anchor. What I'm going to say now really needs to be framed through the thinking of a bottom-up quality growth house. So what I'm going to say now, you just need to think about it in context of that's our North Star. You can see from the title of my presentation, quality growth, it's a bit of a conundrum in what looks to be a slowing economy, and that's the thing that we're particularly focused on. This is a rather sobering slide. We've looked at simply South African economic growth over the last 20-odd years, and then looked at what the average growth rate has been in roughly 5-year periods. And, particularly focusing on the last 15 years or so, you can see that sequential stepping down of growth. Over the last 5 years, economic growth in South Africa has averaged less than 0.5%. Now, we had the GNU arrive last year. Suddenly, we were starting to think to ourselves about all sorts of possibilities, particularly given our mindset of growth and opportunity. We were looking at mid-caps, all sorts of new things. It was very exciting. If you look at the latter part of that chart, that's looking at how economic growth has shifted from where it looked like it was going to be at the beginning of this year, a few months later. I mean, at one point, we were looking at economic growth this year upwards of 2.5%. It's not quite China, but in the context of what we've seen in South Africa in the last 5 or 6 years, suddenly it was looking very interesting. Already we've seen economic growth downgraded to 1.3%. The IMF is saying 1%. And frankly, we'll see where we end up by the end of this year. And that, for us, has caused us to certainly recalibrate a lot of our thinking. I'm afraid we're bringing out the old playbook of, how do we invest in a slower growing economy. Fortunately, this is not our first rodeo. And that's really what I wanted to spend the rest of this presentation talking about, is if we are in for tougher times. I like Sai's analogy of a kangaroo market, because I would say that's very much how we probably see things. What are your opportunities? So now, at risk of stating the obvious, if you can get the earnings right, by and large, you're probably going to be okay. And what I've done is selected a couple of examples of companies, particularly focusing on the last decade, when we've really had very tough conditions in South Africa, that haven't been able to deliver earnings growth for a variety of reasons. Vodacom, Coronation, and Sasol are the ones that I selected. Tried to give you examples of companies across differing sectors. I'm not going to get into why they weren't able to do that, but you can see that really the share prices went nowhere. Whereas if you step round to the companies that were able to deliver growth over that period, you can see how well they performed. And the key message coming through there is even in difficult times, there were companies that were able to grow. The other thing that I particularly want to focus on there is time is their friend. Even if you get the timing a little bit wrong, valuation a little bit wrong, eventually the share price will catch up with those earnings. So a lot of our focus at the moment is in identifying those kind of cast iron growth opportunities that you would go to war with over the next 3 years if we find that the economy doesn't quite pan out as favorably as expected. If we look at a couple of places where we think that will come through, I also need to get my glasses out here just to check my slide. These are kind of areas that we would be looking in a low growth economy for potential opportunities. Successful acquirers, and we'll talk to some of these. This is motherhood and apple pie stuff. We want to give you some examples of companies that will do this. We are looking for companies that in a low growth market still have white space to grow, and there are a few of those. Companies that can capitalize on public sector weakness, self-help situations, few companies that have been investing in growth, and I must say there haven't been very many of them, and then those that have managed to transcend South Africa and are growing successfully beyond our borders. And then finally, you could call them almost the cockroaches of our market, the guys that are gaining market share, the big dominant players. Again, think of that in context of us as quality growth managers. We're very focused on strong, active management teams. So let's look at a few examples of some of these things. I know that's what many of you are here for. If we look at those with clear domestic expansion potential, it's perhaps no surprise that these are relatively new listings. We've picked We Buy Cars. As much as it's grown strongly, its market share in the second-hand car market is still south of 10%. It's busy expanding in South Africa and looking to push that up. If you look at Boxer, its results out earlier this week. It started off in KZN, and no surprise that if you look at where its geographic presence is, a lot of it is concentrated in and around KZN. So there's an awful lot of white space as it rolls out its supermarkets across the rest of South Africa. And interesting, the market seems to have taken a bit of a dim view of its sort of first set of results as a listed company independently, and we think it's presenting quite a nice opportunity at the moment. A couple of successful acquirers, and there are many that aren't. First of all, we've picked CA Sales as an interesting business, probably not that well known. It is a merchandiser across the rest of Africa. It is aiming to double its revenue between 2024 and 2026, a reasonable portion of that through acquisition. It's recently concluded the acquisition of a business called Tradeco, which opens up the whole East African market for it. And then the other one, Hideko, which is probably in the heart and soul of the challenging South African industrial and consumer market. These guys have been excellent acquirers of businesses, typically on a sort of 4 to 6 times earnings, very strong cash generation, very disciplined in the type of businesses that they're looking for. And essentially, they've just concluded their largest acquisition to date. It trades on about an 8 or 9 PE and are very clear about the type of businesses that they look to buy, as I say. So a business that we expect to be able to outgrow through canny acquisitions in South Africa. If we look at those capitalizing on public sector weakness, we really like the South African education space. That graphic on the left-hand side there is a pretty sobering one. I must admit, I'm glad that I'm not looking for a place at university any longer. But it just gives you a perspective on how many applicants there are for essentially public sector universities versus the number of places available for first years, and the mismatch that exists. And then the two examples of companies that really do benefit from that, call it white space as well. Stadio being the most geared to that, as that's all they do. In the case of Advotech, you still have the schools business both locally and in Africa. But both businesses looking like they'll be compounding earnings, solid double digits with a high degree of confidence in that actually coming through. Self-help opportunities, I've only given one here, and I would say that the reason for this is that there's a high bar, particularly in a low-growth economy. We've picked Tiger Brands here, new management coming in 2023, cleaning up the business, getting rid of non-core businesses, investing in their bakeries, and the expectation is that you will start to see that translate into meaningful uplift in margin. And we're already seeing that. They came out with a very nice trading update this week, and always encouraging to see the CEO backing his own story by buying shares. And that's been happening recently. So we're starting to see that come through nicely. Past investment, the two we're just highlighting here, Discovery. I mean, Discovery did nothing for years, and certainly there was a lot of criticism of the amount of money it was spending in Discovery Bank, in the expansion into the rest of the world through Vitality, and you're now starting to see it J-curving out of that. And then Afrimat, which will be producing what we expect to be a very poor set of results tomorrow, but we think it's a little bit of a sleeping giant, having been as a very strong management team with some really interesting businesses in it. Looks like the acquisition of Lafarge is going to turn out to be perfectly timed. And, we think it's a bit of a coiled spring for the next couple of years as all of that investment and these clever timed acquisitions with a strong management team, kicks through in terms of meaningful earnings growth. Growth outside South Africa, Bidcorp, just a monster steadily grinding away, not exactly the most exciting growth story, but a management team that are also great acquirers, clearly focusing on upping the bespokeness of the type of food services that they're delivering. But, literally a platform business. Prosus, in fact, interesting, just before I came here, we had 10 cents earnings just announced, 22% growth. So we backed the 10-cent story, and then on top of that, you've got the share buybacks and a much clearer and more coherent strategy around what it's doing with its non-10-cent business. So, all of that adds up to a steady compounder for us. And then a couple of market share gainers, ShopRite spending more on CapEx than the entire market cap of Pick n Pay. Capitec, we spoke about it earlier on. We think it's going to be a wash, rinse, repeat strategy of how well it's done in retail as it pushes into business banking now. Absolutely rating high, I admit, but this is a business that continues to grow very strongly and has a very clear and coherent growth story. And just remember that point that the share price will grow into earnings so long as you continue to deliver them. Just in conclusion then, as much as it's about making sure you populate your portfolio with those dependable growers, it's also about avoiding the landmines. And without going into too many details, these are some of the lessons that we've learned. Where have we got it wrong? First of all, where we've invested in companies that are based purely on some sort of corporate action. And, in many cases, these are relatively weak businesses where it's a kind of Hail Mary. And, for one reason or another, the corporate action just doesn't happen. Certainly be very careful at the moment of weak balance sheets. I think Murray and Roberts would be a very good example of a failure very recently where, it looked like refinancing was done and dusted and suddenly it wasn't. Avoid business rescue at all costs, because what we have learned with that example is that as a shareholder, you are dead in the water. Businesses that are highly exposed to corporate sector contracts. Generally, the thesis in times of stress is feed pain to the chain. So, as a corporate, as a business, you look to obviously take your pain and feed it to your suppliers. So you push out contracts and what have you. So be careful of those kind of businesses. And then this is not the time to be backing underdogs, frankly. So I think a lot of those are probably self-explanatory. And, as I say, the bar rises in tough times around, what type of businesses you want to put into your portfolio. It's not playing fast and loose. That's the bottom line. And that's really it. I suppose a word of caution. We are definitely thinking hard about upping the quality of our portfolio at the moment. And that's my story. Ready for questions if there are any.
Well, thank you very much. Any questions from the floor? We can see where this is going. And online, I didn't see any questions as well. Very quick one from my side. You mentioned Tiger Brands. It's been 7 years ago since the Listeriosis debacle. And it's been in the paper where there's some sort of settlements, but a lot of families and the lawyers' families are very not happy with that. And almost saying, Tiger Brands hasn't actually made those families whole at all. And if you see stuff like that, how does that influence your thinking of companies like a Tiger Brands? Would you still buy them, hold them, or would you just shun away?
So from a purely bloody-minded investor mindset, the short answer is that as terrible as that event was, it very much lives in the world of the liability of the short-term insurers. So, it's something that when that settlement arises, it's going to be the problem of Tiger Brands as insurers. And, we think in time, obviously, the world moves on and focuses on the numbers. But it's obviously, certainly none of these investment cases necessarily are absolutely perfect on every metric. But that's the short answer to the situation in Tiger Brands around listeriosis. Not their problem, sadly.
It's exactly that, and that's why I asked this question, because that's got nothing to do with the governance at Tiger Brands. It's got to do with lawyers and settlements and short-term insurers. Thank you very much for that, Mike. Really appreciate it. Thank you.
Thank you very much, everybody.
Right, Barry Shamley from Investec Investment Management. We've had you on first a couple of times. Very sorry that you are last for the conference. Barry, thank you so much for being here. Good to have you.
Just checking. Okay, you can all hear me. Okay, so I am officially the last person standing between you and lunch, and I'm amazed so many of you are still here. So the lunch must be very good. I know you're not here for me. Okay, so I'm going to talk about small caps. Small caps and mid caps have been a bit of a swear word over the last couple of years on the JSE. We've maybe had our day in the sun a little bit sort of 2020, 2021. But if you look at the world in particular, it's been the mega caps and it's been the global growth stocks that have dominated the headlines and dominated client conversations, and certainly not SA small caps. And when you look at this chart, you actually have to ask yourself, why bother? If you look at the sort of dark blue, that's pretty much your large caps dominating the investable market. You've got maybe 15 to 20% in small and mid-cap exposure there. You also got to think to yourself, in terms of farm of range, does that even hold anymore? That whole thing was about your sort of outperformance would be based on your size and based on value, like if you're a cheaper price to book value. Certainly it didn't feel like that for a number of years. You also got to look at the performance. I mean, if you look at this chart shows you the relative rolling 5-year outperformance of small and mid cap. So the small is the dark line, the grey is the mid cap. Outperformance of the Aussie over the last 20 plus years. And I need to just sort of reiterate, it is rolling. So that period that you're looking at the start of that period, that's sort of 2000 to 2005. So that really is that period sort of from 1996 to 2000, where we had rates going from close to, I think it was 15% up to 25%. I remember it very well. I just started at Investec as a student. I used to carry Stephen Kossoff's laptop around, and I'd bought my first car, and my take-home pay went down close to nothing after all those interest rate hikes. But obviously it was a very difficult time for smaller companies that had leverage on their balance sheet, and we also had the rand sort of weakening quite substantially over that period. We then went through a sort of a boom period, sort of aligning with that China resource or commodity bull market that we saw in the early 2000s, and sort of SA becoming investable again in the Rainbow Nation story. And then you can see where we started deteriorating again and pulling that back 5 years, you can see that was really around the Nene Gate and the sort of state capture catching up with the market in terms of creating bottlenecks in the economy and destroying our infrastructure. If you look at the performance, yes, there certainly were times where the small cap index did outperform. So the green, or I think that's greeny blue, shows you the times of where small cap outperformed. Mid cap doesn't seem to do particularly well, but over 10 years you did have your large caps outperforming. The one thing we always like to remind people that there's something is always up in the market. I know this is quite difficult to see, but your x-axis is your capped Swix performance, annual performance. So you can see on the 2 years that it was down. Your y-axis is the top decile of shares. So the point is that there is always somewhere to make money in the market. What you often do find is a lot of that time it is in the small and the mid-cap space. So the chart on the left shows you the number of shares outperforming the capped or the Aussie capped Swix over each year. And the chart on the right is actually your percentage of shares that are mid and small cap that are outperforming the capped Swix. So you're getting between 70 and 80% of your outperforming shares come from that small and mid-cap space. Now, I know this is incredibly difficult to see, so maybe you'll have to download the slides afterwards. But what we did here is we looked at the top 10 performers every year, going back, I think it's about 20, 25 years. It's as far back as we could get the data. And the dark blue blocks are the top are shares in the top 40. All the rest are your small and mid-cap shares. And obviously, the point is just here to highlight that you often do find small and mid-caps doing the sort of creating your outperformance there. If you look at the average performance of those shares per annum, it was 93% versus your average top 40 return in those years of 22%. But there's always a catch. If you look on the downside as well, your small and mid caps were quite devastating as well on the downside. So you had an average return of 42%, and you can see most of that of those top 10 underperformers each year were coming from your small and mid cap space as well. And your average return by your top 40 was much more stable and bearable at only minus 5%. So you might then ask, why do you get this outperformance? So in that Farmer French model, they say it kind of depends if you believe in the efficient market hypothesis or if you believe in inefficiency. I lean a little bit to the inefficiency, and I think part of it is because of the lack of coverage that we see in the small and mid-cap space. And you can see in this chart here, the bottom line is your coverage of SA small and mid-cap shares. This is the number of analysts covering shares. And I mean, I think this is a little bit overestimated because I know a lot of the companies I invest in, I don't see 5 analysts covering them. I see 1 or 2, and sometimes it's just ourselves. What is interesting there is that pickup, and like I said, those global large caps were the only game in town, and you can see the US large caps, how that spike in the number of analysts covering shares. So that was obviously where everyone was excited and spending a lot of time. Another anomaly we found out while we were doing this exercise was that small and mid-cap funds don't necessarily always capture the returns on offer. So this is the ASISA mid-cap is the mid-small cap are the sort of the bars, and then there's the solid lines are your mid-cap and your small-cap indices. And you can see in some years, I think it's 2002, 2003, you saw quite stark underperformance from those funds, as well as 2019, 2020. And we started questioning why that was. And I think part of it, well, I think a large part of it is a lack of liquidity. So it's quite important when we decided in sort of creating our fund mandate for the particular fund that I'm involved in, the Investec BCI Dynamic Equity Fund, we wanted to ensure we were able to invest outside of the small and mid-cap space, because that lack of liquidity can bring a lot of problems with it, especially if you have to provide daily liquidity for your clients. Also, it's very difficult to replicate these small and mid-cap indices because a lot of these companies are very illiquid, there's a very wide spread, and in times of panic or exuberance, there's often not a bid on the buyer side or an offer on the sell side. So what makes us different, or what are the skills required in order to play in this space? So I think it's experience. A couple of my colleagues also always say this. I think Ryan Friedman, probably most familiar to some of you, always says it takes 25 years of experience to get 25 years of experience. Obviously that changes as a year. A few years ago, he used to say 10 years of experience. But we've got 25 years of experience now in this space, and it's very important when you come to discussing the following 2 points. The governance focus, understanding the culture of governance at a company, and also the incentives of the management. Are they trying to buy companies to buy headline earnings per share, to have a bigger market capitalization so they can have a bigger salary, or are they focused on return on capital and improving the profitability on the company? Lastly, you need quite a strong temperament. Like I said, the liquidity is not for sissies. And most importantly, you need clients that understand your process. You often don't move with the market. So while we do have exposure to large cap to try and capture some of the beta of the market and admit that there are always some opportunities in the large cap space, you do need to understand that you're not always going to trade in line with the market. But over the long term, hopefully, looking different to the market, fishing in this part of the market will lead you to better returns. Just showing you what we did here. This is a batting average. So what we did was we took the JSE top 40 versus the top 40 plus 75% and 12.5% in mid and small cap. And over 5-year rolling, 60% of the time that basket outperformed the market. I asked them to check it on a shorter period because I thought it would do worse. It actually does even better on a shorter period. So over 3 years, 67% of the time, that basket, including small and mid caps, improved your performance. It also improves or reduces your volatility. And here we did that same exercise with that top 40 and the small and mid cap. And you can see, obviously, with the lower correlation with the small cap of 0.49 versus the top 40, you would expect that reduced volatility. And then lastly, to wrap up, save you a little bit of time, this is how we look. We have about 41% exposure to large cap, about 31% to mid cap, and about 25% to small cap. Like I always reiterate, this portfolio is best used as a satellite portfolio. It's not for your core equity exposure, but hopefully it gives you something different and adds a little bit of alpha over the long term. And hopefully we've proven ourselves with some of those great awards we've been awarded at the bottom. And that's it. 2 minutes to spare so we can get to our lunches. Thank you very much.
Thank you. Thank you, Barry. A question from the floor, just very quickly. I really want to get to that lunch right. One question from the online audience. 1 or 2 high conviction ideas in your portfolio at the moment?
Okay, I thought about that. I'm going to give one because I met with them yesterday, and that's like going back to that 25 years. Like we meet with these management teams regularly. We know the guys. So the guy I met with yesterday, Sean Walsh from KAL Group, Carp Agri, they went through a tough period now, but things are looking like they're turning around. It's on a P of about 6 times. They're in sort of fuel stations, and they're also in Agrimark, which are sort of a small sort of macro type stores in the rural areas. And they understand capital allocation. We often talk to them about return on invested capital. There were a couple of once-offs in these results in terms of permitting of new petrol sites, and we think they're through the worst and things will start picking up from there. So I'll leave it at that, just that one.
Barry, thank you very much. I believe you are joining for lunch as well.
Yep.
If you do have more questions from Barry, please engage. Barry, thank you.
Thank you so much.
Good stuff. That brings us to a close for our conference for 2025, all 3 days. To our audience here live, thank you very much for joining us, and our online audience as well. Thank you for making the time to join us online. To the multimedia team at the back, always professional, great setup here, everything run smoothly. Dan Stilleman, Excel Academy, running our platform at the back end. Thank you so much. And to the BCI team, Tanya, Olga, and everybody that sweated blood and tears for the past 4 months to get this all going, thank you so much. But most of all of you here, thank you for making BCI a great success. And that brings us to a close. My boss is here again. He wants to say something. Robert.
I just want to say thank you to Eugene. You see him every Wednesday. He's like clockwork. He's like my Saturday email to the investment partners. Eugene, I just want to say thank you very much.
Thanks, Robert.
I appreciate it.
Good stuff.
And then to everybody online and here, thank you for making time. We cannot do and we cannot make such a success of our business without you. It's because of you that we're here, because of your clients that we're here. Thank you. As at the end of last month, we had roughly 450 billion assets under management or administration, which makes us by far the biggest manco in the country. 10 years ago, we had 2 billion. And again, it's thank you to you. Appreciate it.